I am host of today's event. I feel privileged to welcome you all to this virtual seminar on tax audit, recent developments, jointly organized by Nellore branch, Tirupati branch, and West Godavari branches of SARC of ICAI. I welcome our West Godavari branch secretary, CA D. Vishwanath sir, Nellore branch vice chairman, CA VL Harishankar, Tirupati branch chairman, Narasimhulu sir, and all other MC members to today's seminar. We are also joined by our SARC member and Nellore branch ex officio member, Sunil Kumar Mandava sir. I also welcome our today's CA V. Ramnath sir to this webinar. Let us begin the event with virtual lighting of lamp and ICAI motto song. As a mark of respect, we can place our hand on heart. We need not stand. Thank you.
येषः सुप्तेषु जाग्रति येषः सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते सर्वे तदूनात्यपि कश्चनान्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, everyone. I request Nellore branch vice chairman CA VL Harishankar to present opening remarks.
I'm not able to hear.
Is it audible? Harishankar, it is not audible to us.
Not audible, sir.
Unmute.
నాదా ఇప్పుడు మాటలు వినిపిస్తారు కదా మనం ఏం చేయలేదు ఇట్లా పెట్టాను కదా నెట్ పెట్టింది నెట్లో ఉండడం
Harishankar, is it audible? Sir, everyone, is it audible?
It's audible to your voice, Rajesh Garu.
Harishankar?
No, his voice is not audible.
Okay.
From your end.
I request West Godavari branch secretary CA D. Vishwanath sir to speak. Vishwanath sir.
Sir, Harishankar garu, are you busy, sir? Are you available, sir?
Sir, there is some problem.
Yes, Vishwanath, we can hear you.
So, a very good evening to one and all. I firstly welcome you all to this one of a kind session organized by the three branches, Nellore, Tirupati, and West Godavari district branch, for the in the topic relating to tax audit. Tax audit has become such a cumbersome process nowadays that not one seminar or two seminars are sufficient. Each clause is now requiring one seminar. So that is the complexities that have cropped up in this tax audit nowadays. Also, the implementation of centralized processing has made things more difficult for everyone. Because interpretation of one clause by one person may not be the same for another person, and the department should also have a lenient view in various genuine cases which are being cropped up nowadays. So I request Ramnath garu to throw some light in this regard and give the best possible solution for in a practical approach. Thank you, sir.
Thank you, sir.
Audible now?
Yeah, I request Nellore Branch Vice Chairman CA VL Harishankar to speak a few words.
Guys, first of all, sorry for the technical issue. So I am starting again. It's like hello and welcome to everyone. The first and foremost, I would like to thank our speaker, Sri CA Ramnath garu, for devoting his valuable time to delivering the session, as well as our Nellore Branch ex-officio member, Sri CA Mandav Sunil garu, and all the participating members of Nellore, Tirupati, and West Godavari branches of ICAI. Today, we will discuss the most important area of our practice, where the rules are constantly changing, which makes it a mandatory upgradation to practicing professionals on a regular basis. And thus, we have come up with the topic, recent developments in tax audit. We are very excited and really enthusiastic to learn on new developments. Thank you.
Thank you. I request Tirupati Branch Chairman CSC Narsimhulusa to speak a few words.
Thank you, Rajesh garu. Respected SARC member CA M Sunil Kumar garu, Chairperson of Nellore Branch CA Venkata Madhuri garu, Chairman of West Godavari Branch CA Ravikaran garu, though both are not available here, but who are instrumental from their branches side in coordinating to this VCM. Resource person of the day, Sri CA V Ramnath garu, the committee members of all three branches, our beloved members, and other attendees. A very good evening and warm welcome to the virtual seminar and tax audit with recent developments, dear members. Dear members, as we all know that the tax audit is one of the major works every year in any CA firm. Though this is a recurring work every year, somehow every year there may be certainly some changes or amendments takes place. Likewise, for the assessment year 22-23 also there are some changes, of which the important one in this year is applicability of class 44 of 3CD, which is reporting of GST transactions. It is bifurcating the expense into expended through GST registered persons and non-registered persons, and with registered again into exempt and from the composition and regular. As we all know, this class was introduced in July 2018 and thereafter getting deferred till this year. Differing for almost 4 years itself indicates how complex it is. There may be many doubts for the members on this class. Our esteemed speaker Ramnath sir will deal in detail on it. Likewise, other complex areas such as trading in shares and securities, especially intraday and F&O, and how the turnover to be considered for tax audit will be crucial in recent years. Dear members, needless to say, our speaker Ramnath sir is much expertise in all these kind of complex areas and having rich experience in serving the members through seminars from so many years. Due to his hectic schedule and not to miss his valuable service, we three branches at once organized this joint seminar. So I request members to actively participate and interact with our speaker and enrich your knowledge. My sincere thanks to our speaker Ramnath sir for giving this opportunity for our branches and members. Thank you all. Thank you for giving this opportunity.
Thank you, sir. Thank you. Now I request Nellore branch ex officio member CA Sunil Kumar Mandava sir to address the audience.
Good evening to all the delegates. And first of all, I thank very much to our speaker, Ramnathan sir, who has accepted on my first call to address our branch. So I thank you, sir, very much for giving us a great opportunity. But I also thank the branches of Tirupati and West Godavari who are also interested in participating along with us. It's whatever the topics we choose, it should belongs to the members whose benefit we are organizing. So it's only the thing, how much the members will take input from today's session. Since yesterday we have received a guidance note on tax audit also. So please, the members, please go through. There are a lot of changes which has to be implemented. So please follow the speaker today and get thorough knowledge in the subject. Thank you for giving me this opportunity.
Thank you, sir. Thank you. Now I request CA Satish from Tirupati branch to introduce our today's speaker to the members.
Sir, good evening, sir. Hello.
Yeah, it's audible, Anna.
Okay.
Please, your
Okay.
video, please.
Yes.
Yes.
So it's my immense pleasure to introduce today's speaker, C.A.V. Ramnath Garu, to the audience. C.V. Ramnath is a BCom graduate and a fellow member of the Institute of Chartered Accountants of India. He had underwent his graduation in Government Arts College, Coimbatore, Tamil Nadu in the year 1990 to 1993. He pursued his chartered accountancy course during the year 93-96 under Sri K.S. Palaniswamy Chartered Accountant, Coimbatore. He had cleared his CA intermediate exams by obtaining 33rd rank on All India basis and the CA final by obtaining 43rd rank on All India basis. Also, he was a gold medalist at Coimbatore branch in CA final. Presently, he is a partner in Mrs. K.S. Palaniswamy and Co. Chartered Accountants, Coimbatore. He has 26 years of experience in handling audits of various corporate and non-corporate entities. He also handled the appeals under Income Tax Act up to Income Tax Appellate Tribunals. He handles corporate and non-corporate restructuring cases. He was a faculty for the CA Final Direct Taxes paper at Coimbatore branch for 17 years. He presented papers in indirect taxes in seminars and conferences organized by various branches of the ICAI. He also addressed the students of various colleges on topics related to commerce, taxation, etc. He is also a member in the academic and governing council of various education institutions at Coimbatore, Tamil Nadu. He was a co-opted member of the Direct Taxes Committee of ICAI New Delhi for the year 2020. Further, he was a co-opted member of Direct Tax and International Taxation Committee of SCLC of ICAI for the year 2020. With this small introduction, I like to present a speaker to the gathering. Thank you. Thank you very much.
I request our resource person, C.A.V. Ramnath sir, to start today's session. This tax audit is a very relevant topic for all of us, sir. So today we expect a lot of confusions to be solved from your session, sir. Thank you.
The ex officio member of the Nellore branch and SARC member, and 3 branches, managing committee member, chairman, secretary, other office bearers for all the 3 branches, and senior members of the profession who continue to guide this profession. Fellow members, it's immense pleasure for me to be amongst you this evening to share some of my thoughts on the topic, as rightly mentioned by all the people, that this particular topic is going to be one which is, even though introduced in 1984, still relevant and contributes for major chunk of work for our professionals in many of the cases. And as rightly said in the initial remarks, it adds confusion after confusion, and the understanding, interpretation, additional classes or institute guidance note all adds one after the other, and therefore this topic assumes a lot of importance, and I would like to spend few minutes of my on this topic, and we'll try to ascertain certain collective wisdom so that we'll all would be discharging our responsibilities properly to the expectations of the authorities, and also to see that the attest function is carried out appropriately. Before we dwell upon a line of caution to say. The institute took the copies of the tax audit reports signed by our members and made a study, and the relevant body within the institute is Taxation Audit Quality Review Board. The TAQRB, Taxation Audit Quality Review Board, came out with an article in last year May month journal to say what are the major observations where our members report, where the contents of the members report found falling short of the requirements of the audit expected by the institute and the pronouncements. So that was a small 3-page note was there in the May 2021 journal of our ICA. Recently in June 2022, this was made as a publication, a study on tax audit report, and it is available in web as well as printed copies are available, where class by class the requirements of our institute expectation and the pronouncements and what went wrong in some of those reports were codified and presented by TAQRB. I would request the members to go through that particular study on tax audit report issued by TAQRB so that the same errors would not be found in the report signed by us. That would help us to see that that is acting as a checklist. Also, the same TAQRB prepared one checklist for tax audit report. Before releasing the tax audit report, if we follow those checklists and obtain the management representation letter wherever it is mentioned in that checklist, that would serve as a guide and as well as an insurance for all our members. Tomorrow, if something goes wrong, at least these papers would definitely help us. So my sincere request to all the members would be to study that publication of TAQRB on the study on tax audit report, and also keep the checklist issued by the institute. One copy PDF is also available and other Word version is also available, which when we can make use of it, that would definitely help us to serve the profession well. Having given this prelude at the beginning, we'll now come to the topic proper. The recent developments, of course, though the title is recent, it is a very subjective term. Therefore, we'll have some basic understanding on that provision and we'll continue further with other classes. So to quickly rush through the basics, the section giving us this particular opportunity to do service would be section 44AB. And we have 5 classes therein. The first class has got a proviso which requires a slight elaboration. Every person carrying on business shall, if his total sales turnover gross receipt as the case may be in business exceeds 1 crore rupees in any previous year, shall get the accounts audited. So normally 1 crore, if it exceeds 1 crore, audit is necessary in a case of a business. Now a proviso came 2 years back. Now that is assuming importance. A proviso says, in a case of a person whose aggregate of all amounts received, including the amount received for sales turnover gross receipts, the proviso doesn't start saying aggregate of all amount received towards sales turnover gross receipt. Aggregate of all amount received, including amount received for sales turnover gross receipts during the previous year in cash does not exceed 5% of the said amount. So receipts, all receipts versus receipts in cash, we compare, and the receipts in cash is 5% or less, then this class A of the proviso satisfied. Similarly, aggregate of all payments made, including payment amount incurred for expenditure in cash during the previous year does not exceed 5%. This clause will have the effect as if for the words 1 crore, the word 10 crore substituted. Originally 1 became 5 in financial year 20 March, financial year 21 March it became 10, continues to be 10. It's a usual practice sometimes where from the bill to act a few more points are added. Usually we will spend more time on finance bill related provisions. When it becomes act, we believe that same language is important and therefore lesser attention is provided for finance act related changes. Therefore, I always used to request branches to arrange one meeting after the finance bill becomes finance act, because there are so many changes made from bill stage to act stage, which generally goes unnoticed. When the provision of proviso to class A came, the class A, class B therein with effects for the words 1 crore, the words 5 crores substituted for assessment year 2021. Assessment year 21-22, 10 crore, 5 crore became 10 crore. From bill it was not there, and the act stage another proviso was introduced. That proviso says, provided further that for the purpose of this clause, the payment or receipt as the case may be by a check or drawn on a bank or a draft, which is not account payee, shall be deemed to be payment or receipt as the case may be in cash. When this proviso was not there, what is accounted in the cash book as cash receipt or cash payment would be sufficient for the purpose of ascertaining this 5%. Whatever has come through other than cash, it could be a normal check or an account payee crossed check or a simple crossed check or open check, would also be reflected in the bank statement. Therefore, we can say all of them as collection through bank or remittance through bank. Now, the second proviso came to say if it is a check or a bank draft which is not account payee, it shall be deemed as cash. So now practical challenge starts. This second proviso at the bill stage was not, but at the act stage it has come, and therefore it is from assessment year 21-22 it has come. So for last concluded assessment year and the year for which we are now going to do audit, we'll have to see how we are going to comply with this particular provision. So now, on a careful reading of the class A and class B of the proviso says receipts or payments, including receipts towards sales, including payments incurred for expenditure. So not only the items which are falling in a revenue account like P&L account, trading account, manufacturing account, we must also consider the items coming in a balance sheet like capital transactions, in other words, to be considered for the purpose of ascertaining this 5% threshold. Not only revenue transactions but also capital transactions have to be factored for the purpose of ascertaining this 5%. Then next issue arises, if it's an other than account pay check or draft, it will be considered as part of cash. In which scenario, how do we make this checking and document it? There are certain banks, they in the statement itself would say the cash transactions as cash. If the check is presented across the counter, the statement would say to cash hyphen so and so name. And if an open check is issued by the assessee to his vendor, and that open check is presented at the counter of the bank, then the bank would say in the statement itself to cash hyphen so and so. So those cursory glance of the bank statement would help us to know whether they are open check. But it had been not open check but a simple cross check, it is going to be difficult, because a simple cross check will come through clearing or it will come through transfers. Therefore, it will be as good as account pay or otherwise. So at least open check we would be able to see by seeing the bank statement. If the statement reveals their cash collections or cash remittances across the ATMs or cash withdrawals from counters. So if this is the case, this should be treated at par with it. But in an audit procedure, definitely it will be a time-consuming exercise. So when it is going to be a large time-consuming exercise, we can at least fragment it and do test checking. So if the volume is very heavy, then we can say we will take once in a quarter some 15 days or 20 days, or every month some 5 days. We'll document in our working paper for the purpose of checking whether remittances of cash or withdrawal of cash through open checks considered as direct payment to parties. We can just go through the statement of those 15 days, compare with books and see how it is reflected, and our books, if at all, go along with the statement appropriately. Our observations for all those fragmental periods, test checking periods are perfect. That would be sufficient for us. In case our test check reveals that certain transactions recorded in the book speak differently, and we'll have to increase the sample size to satisfy ourselves. And it is not necessary for 365 days we will have to do this, but at least we will have to do for some period, and we'll have to have documentation with us to say in which assessee's case, which period we had done this exercise. Not necessary that whole 365 days we have to do, but at least some days in a systematic manner in every quarter, this particular period, we have cross-checked, and the cross-checking for a test check basis we have carried out. That has not revealed anything surprise. Therefore, we presume what is accounted in the books is perfect, and therefore we ascertain this 5% category. That documentation alone would help us to handle this case perfectly. Otherwise, because of the introduction of the second proviso, without documentation, just by going with a cash book entries, if we conclude, that may throw some challenges at a later stage for the professionals. Then issues could be many on this because it's recently introduced 2 years provision, but picking one or two matters on that. If a sole proprietor introduces cash in his business books, or a sole proprietor withdraws money from his business for his personal purpose, whether that should also be figured out for the purpose of reckoning this 5%. It's a question before us. When a sole proprietor introduces money into his business, it is not that he is receiving from somebody. There must be a receipt. It is his own money he is introducing. Therefore, the contribution of the sole proprietor into the business, either in check or in cash, from his personal bank account, he would have introduced into business books by check, or from his personal account, he would have given in cash. Both cash instrument-based investment, cash-based investment must be excluded for the purpose of ascertaining this 5%. Similarly, withdrawal of sole proprietor, either in cash or through instrument, have to be excluded because it is not from his business books, it is moving to personal books. That is not to be considered as payment. Therefore, it has to be excluded. In balance transactions, we have to decide, apply 5% criteria on the balance transaction. Now, if the same logic is extended to a partnership firm or an AOP or BOI, can we be in a position to say that the partnership firm, partners contributing to firm, partner withdrawing from the firm, AOP or BOI, members contributing to the AOP or BOI or withdrawing from AOP or BOI, can it also be removed for the purpose of deciding this 5%? I personally feel that would not be an appropriate way, because under income tax law, firm and partners or members or AOP are separate taxable entities. Therefore, that could be considered as an independent transaction between firm and partner, or between AOP or BOI and its members. Therefore, that should not be excluded. But in case of proprietor, of a sole proprietor of an assessee, we would be able to defend this, saying there is no receipt or there is no payment as such. Now, interestingly, the limit of 1 crore getting extended to 5 crore previously, now 10 crore, is applicable only for class A. So government says, if your business is through banking channel for 95%, we'll accept the transactional results as it is. There is no audit warrant. For a higher threshold, if your transactions are routing through more and more in cash, we wanted to have a check and balance. Therefore, we will have to expect you to get the accounts audited. That extended limit fixed for business only. It is not fixed for professional cases. Let us say 50 lakh rupees limit for professional cases. Similar extension is not provided for professional cases. You do 95% above in banking channel. Those cases, can they say instead of 50 lakh up to 100 lakh, there is no audit oriented. There is no such provision provided as of today. All the more it is good and welcome to do so, but unfortunately they have not addressed it. So that this limit extension would be applicable only for business cases and not for professional cases. Now, there are certain interplay between 44 AD and 44 AB. And so long as the limit of 44 AD and 44 AB were one and the same, the confusions were less than 1 crore rupees 44 AD, more than 1 crore rupees 44 AB, and no plus and minus on it. The life was very comfortable. Less than 1 crore 44 AD, 8% or 6% you offer as the case may be. And in case you are unable to offer that much, get the accounts audited. More than 1 crore, anyway you audit it, matter ends. Life was so comfortable at that point in time. Now, limit of 44 AD went up from 1 crore to 2 crore, but limit of 44 AB retained at 1 crore, correspondingly was not increased. Question arose as to whether between 1 to 2 crore, when a person comes under 44 AD, 44 AB is applicable or not. Question came. Therefore, first proviso came to say, so long as you go with 44 AD, for you instead of 1 crore up to 2 crore, 44 AB is not applicable. Now, above 2 crore up to 10 crore, obviously 44 AD is not applicable. For that SSE, then we'll have to examine 44 AB. And if it is 95% or more non-cash transactions, then obviously that SSE would be entitled to say is not required to get the accounts audited comfortably. Now, if a person in a preceding year under 44 AD subsection 1, now current year he gets out of 44 AD. There can be two reasons where he can get out of 44 AD. One is current year the turnover limit crossed 2 crore. Let us say in an example, last year his turnover was 1.9 crore. He went under 44 AD subsection 1, offered 8%, filed as a return of income for 21 March. 22 March, his turnover became 2.1 crore. So this year he walks out of 44 AD not optionally but compulsorily, because once turnover crossed 2 crore, he cannot remain in 44 AD. So when he walks out of 44 AD, not optionally but compulsorily, now 2.1 crore. We examine the receipts and payment side, it is less than 5% cash. Now, obviously he has walked out about 2 crore, but up to 10 crore, he has receipts and payment side less than 5% cash, therefore audit not warranted. Now I'll make the example slightly different. Last year 1.9 crore. This year 1.95 crore, less than 2 crore, is otherwise entitled to be in 44 AD. But this year his margin came down, he is unable to offer 8 or 6%. He is unable to offer 8 or 6%. So that means 5%, 6% is able to make it up. Last year he was under 44 AD subsection 1. This year he walks out voluntarily, otherwise he is entitled to. In which case he is required to get his accounts audited under 44 AB class E. Now this 1.95 crore turnover you examine, less than 5% cash dealing. Can he say, I am above 1 crore, but less than 10 crore, less than 5% cash dealing, therefore I am not required to get the accounts audited. The proviso is not placed below class E. The proviso is placed only below class A. Therefore, the cases where the turnover is still within 2 crore, but unable to offer 8 or 6%, therefore the SSE walks out of 44 AD. Preceding year he was in 44 AD subsection 1. In those cases, even if the SSE says his cash dealings are less than 5%, 5% or less, nevertheless, he has to get the accounts audited. But when his turnover crossed to 2 crore, he is compulsorily out of 44 AD. In that case, when his turnover crossed 2 crore but less than 5% cash dealings, then if up to 10 crore, he can get the benefit of proviso below class A of 44 AB. So that two distinction one has to keep in mind when examining the applicability of section 44 AB class A read with proviso. And we have class B talking about profession where gross receipt in profession exceed 50 lakh rupees in a previous year, and 44 AE cases not able to offer the minimum threshold prescribed, then audit would be required according to class C. Why we are saying these classes? Class A, class B, class C, class D, class E. And we have first proviso, second proviso, third proviso, more importantly, third proviso. This A, B, C, D, E and third proviso we'll have to remember carefully, because class 8 of 40 form number 3CD says under which class you are doing audit. Now your turnover exceeded 1 crore but up to 10 crore and it is less than 5% category, and therefore you are not doing audit. The audit report itself will not come, no problem. But turnover exceeded 10 crore business cases, then we will have to go by class A, provided it's not a corporate entity or any other entity like LLP or a cooperative society. But we have class B, profession exceeding 50 lakh rupees. Doing audit for those cases, we will have to stay in class 8, class B. We have to choose class B. 44 AE cases unable to offer the minimum threshold prescribed, then we will have to choose class C. The profession coming under 44 AA subsection 1, those 11 professionals unable to offer 50%, so long as the gross receipts not exceeding 50 lakh rupees, but income exceeds basic limit, the requirement of audit arises on account of 44 ADA, for which class D would apply. And where a person claimed in the preceding 5 years any year 44 AD subsection 1, and this year he could not offer 8 or 6% and turnover is less than 2 crore rupees, then he has to get the accounts audited according to class E of 44 AB, read with subsection 4 and subsection 5 of section 44 AD, if the income exceeds basic limit. Then all these 5 cases, the accounts are required to be audited before the specified date, and the report has to be furnished by that date. Now, the language of the law is giving an impression that the accounts of the previous year audited by an accountant before the specified date. Specified date in the current year is 30th September. The requirement of audit by the assessee from the auditor should be completed not on the specified date, but specified date, before the specified date. That means latest the report can be only 29th September. And the furnishing of such report can be by that date. The report can be uploaded on 30th September, but the audit report should be dated latest by 29th September. It can be uploaded on 30th September. That is very important, because there are certain cases where audit report is also dated 30th September and uploaded also on 30th September. That has resulted in officer levying penalty and matter traveled up to tribunal, and tribunal read down the law to say it must be read as on or before the specified date, and even if the report is dated 30th September and uploaded on 30th September, the penalty should not be levied. This will create some nuisance and we'll have to travel up to tribunal to get the relief. Instead, if you take this caution that audit gets over by 29th and only uploading takes place on 30th, nothing wrong in it, at least that to that extent, this controversy could be avoided. Now, there are certain practical aspects we will have to keep in mind, because today, more than law, the computerized environment only deals with many of the matters where we will have to be careful, failing which on a matter which is not worth spending that much time, professional time would be definitely deployed to set the errors right. Take for example, September 30th is the day for uploading the report at last, and the assessee has got a time to file his ITR up to 31st October, according to the due date for filing the return of income. No worry. Now, one assessee had filed the audit report and as well as return of income on 17th of September itself. Though there is a time to file the return up to 31st October, time to file the audit report up to 30th September. On 17th September itself, the assessee has filed audit report as well as the ITR. First, auditor has uploaded. Next, the assessee has logged in. Assessee's return is also ready. Assessee's audit report waiting for the approval. Because of some way of addressing the issue quickly, the assistant first uploaded the ITR and thereafter approved the form number 3CB 3CD. Now what happens? System reads that it's a case where turnover exceeded the specific limit. The moment the ITR is uploaded, at that time, system reads whether there is any audit report in from number 3CA 3CB available, approved by assessee. Now in this case, 17th September, evening 4 o'clock, 30 minutes, ITR uploaded, 4 o'clock, 31st minute, form number 3CB uploaded. Now system reads on 4 o'clock 30 minutes whether there is any form number 3CB. Now form number 3CB is not there. So system says you have not got the accounts approved, there is no audit available, but audit is available subsequently. Now system sends a notice. Defective return. While filing return, you have not given the audit report. Under 139.9, it's a defective return. Cure the defect. So these are all matters where assessee can say there is a time to file return up to 31st October. There is a time to file report up to 30th September. On 17th September itself, I have filed. What's wrong in it? But system doesn't read up to the end. System reads on a particular minute or a second to say, at that point in time, if there is no audit report approved by assessee, system says, you have filed a return without audit report available at that moment. Therefore, we take your return as defective. And take this and cure the defect. Now, though slightly out of context, had it been not 44AB case, but a trust case. Now, same number, September, form number 10B, October, ITR 7, 10B, September 17th, 431, 10B uploaded, September 17th, 430, ITR 7 uploaded, Section 12A, subsection 1, class B reads that in order to get the benefit of section 11 and 12, the return, the assessee must have obtained and furnished audit report before furnishing return of income. So 4:30 p.m., system sees ITR 7. Just few seconds before it checks whether there is any form number 10B uploaded. Not uploaded. It will not call this return as defective. It will say you are not entitled for 11 and 12. When it says you are not entitled for 11 and 12, it will remove all your application and will start processing your return and raise a demand for the gross receipts. All your applications shall be rejected. For your gross receipt, you will get a demand from CPC. So therefore, first the audit report has to be approved. Then the relevant ITR has to be uploaded. There are past cases where people have got notices for charitable trust where because of these technicalities, they were exposed to pay, to receive a demand for the entire gross receipt. Thank God, we have now got a circular where a jurisdictional exemption CID can entertain the application if the delay is less than 365 days. The delay is more than 365 days, but up to 3 years, the principal CCIT exemption can entertain an application under section 119(2)(b) and condone the delay in filing the concerned form number 10B. That benefit is given for 10B, 10, 9A, ITR 7. At least to that extent was a welcome move. But in case of business cases, we will not require to have this problem. But of course, there will be a necessity to file a belated or a revised return in order to call this 139.9 defective return will come. You have to cure the defect. These are all cases where we will be spending our time, but that may not be really worth for it. Therefore, a little more care in orderly doing this exercise may avoid this sort of a great surprise on numbers. When the number come on these matters, definitely it is going to be a great surprise that could be avoided by properly placing this particular order of filing. As I said, first proviso that 1 crore to 2 crore gave an exception for 44 AD. Second proviso deals with certain non-resident cases. Third proviso deals with cases where the previous year under this law and under any other law to which the assessee is required to have the accounts one and the same, like LLP, company, cooperative society, and audit under any other law is already carried out. Under income tax law, audit is not required. That audit report is sufficient, and you will have to give form number 3CA instead of 3CB. Let me underline again, where audit under any other law carried out and that report is relied on, under that law, we will have to have that audit done, and the previous year under income tax act under that law should be one and the same. In which scenario, when we are not carrying out audit under income tax act, but under any other law and previous year remains the same, then we can say in that case we will issue form number 3CA, 3CD. Whenever we are issuing 3CA, 3CD, in class 8 of form number 3CD, we will have to choose necessarily third proviso to 44AB. While choosing the applicable, class 8 says under which clause you are carrying out audit. When we are issuing 3CA, we will have to necessarily choose third proviso to section 44AB as the appropriate clause under which we are carrying out income tax when we are issuing 3CA, 3CD. When we are issuing 3CB, 3CD, it could be class A for business, class B for profession, class C for 44AE cases, class D for 44ADA cases, class E for 44AD cases. But this all 5 would come for 3CB, 3CD. When we are giving 3CA, 3CD, it should be third proviso to form number, third proviso to section 44AB is what we will have to choose, and it should be for 3CA, 3CD. This is something we will have to carefully keep it in our mind. Now, quickly, certain examples we see. Mr. Q is engaged in retail trade and money lending business. His turnover and profits for the first year of business is like this. Money lending 25 lakhs, turnover 5 lakh rupees net profit, margin 20%. Retail trade 50 lakh rupees, turnover 3 lakh rupees, margin 6%. Totally 75 lakhs turnover, 8 lakh net profit, 10%, 10.67% is the profit. Now the assessee would like to vivisect and decide. For the money lending, he will go by 44AD, just by offering 8% instead of 20%. And for retail trade, he will go by 44AB, offering 6%. Being a retail trade, he would have received in cash. 6% is not minimum, it has to be 8%. So, but since he has got 6%, he will go under 44AB. Can he do so? It's a question before us. Now, the law took its own course of time to reform itself. Earlier, we had 44AD for civil construction only, 44AE for plying of goods carriages, 44AF for retail trade. Then that retail trade 44AF went away, got merged with 44AD. So civil construction, retail trade, and all other business put together, other than 44AE, became the subject matter of 44AD originally. So 44AD originally had civil construction. Subsequently, it has embraced within itself not only civil construction and retail trade, all other eligible business other than 44AE subsection 1 categories. So that means 44AD takes within its sweep all the eligible business. So we will have to see, for the purpose of 44AD, all eligible business put together for that assessee, not within that eligible business, each business separately. That is not permissible. So we will have to see for all the business put together. Now all the eligible business, money lending is one eligible business, retail trade is another eligible business. So all eligible business put together 75 lakhs. And the net profit is 8 lakh, that is more than 8 or 6%. So for the all eligible business put together, he can see is offering 8 or 6%. Not that for each of the businesses within the eligible business, necessarily he has to offer 8 or 6%. In aggregate, turnover of all the eligible business, net profits of all the eligible business, he can aggregate and see whether it is more than 8 or 6%. If it is more than 8 or 6%, as the case may be, depending on cash and non-cash transactions, he can offer cumulatively and collectively. So in this case, assessee can either opt for 44 AD for all the business put together, namely money lending and retail, and go and offer 8%, nothing wrong in it. Or yes, if he is not going to, nothing to worry. Being a first year, it's a first year of his business. 44 AD subsection 4 would apply only when previously he is under 44 AD subsection 1. Previously is not there under 44 AD subsection 1. Merely because he is offering less than 8 or 6%, there is no compulsion for him to get the accounts audited. So if he is willing to go under 44 AD, he can show 44 AD 10.67%, or else he can go with book results with the same 10.67%. Nothing wrong in it. But vivisecting the eligible business into 1 or 2 bundles and thereafter saying one out of that I will go for 44 AD, other one I will go out of for 44 AB is not permissible. All eligible business, he should do it together. Now, P and Company, a firm engaged in manufacturing matchboxes, turnover for the first year is 80 lakhs. It has got in profit of 4 lakhs after interest and remuneration. Examine the applicability of 44 AB or AD. It's again first year. To buttress the same point, I'm picking up this example. In order to come under 44 AD subsection 4, first the assay has to see whether from 17 March onwards, 17, 18, 19, 20, 21, those 5 years, any 1 year he has offered under 44 AD subsection 1. If it is so, then only in the year of withdrawal, the restriction conditions would apply. Now it's a first year, therefore there is no restriction for him. He has never availed 44 AD subsection 1 in the past. Therefore, there is no restriction under 44 AD for 4. Now for him, 80 lakh, 5%, 4 lakh. Less than 8 or 6%. Everything cash, 8% should be offered. But everything cash, he is offering 5%. Nothing wrong in it. There is no need for 44 AD. First year, he can go with book results. He has maintained books of account with book results. He can offer this 4 lakh rupees for the firm and pay tax, file the return of income. There is no need for worrying about 44 AD. Mr. S is running a lodge. His income from the lodge is 3.5 lakh, which is 5% of the turnover, all received in cash. He is eligible for deduction under ATC for 1.5 lakh rupees. He has no other income. Now, assuming for a moment in the preceding year he has availed 44 AD1, this year he is offering only 5%, therefore he is walking out. Predominantly, since he is walking out, one may think that audit is necessary, but the subsection 5 says if subsection 4 applies, however, also you must ensure that his total income exceeds maximum amount not chargeable to tax in order to get 44A2 and 44AB. That means he is offering 5% on this 3.5 lakh. After claiming 1.5 lakh ATC, the income falls below the basic limit. If it falls below basic limit, audit is not required. So last year he claimed, but 1 year he claimed 44 AD subsection 1. Current year, it is falling below 8% on cash transaction, below 6% on bank transactions. But his total income is falling below basic limit. There is no need for getting the accounts audited. Take this example. It's a partnership firm engaged in the business of trading in rice. From 17 March onwards, up to 21, all these years the turnovers are less than 1 crore. And for our academic discussion, all profits are 5%. Less than 8%, all cash transaction. Less than 8%, therefore voluntarily underwent an audit. For all these years, he underwent an audit. Now this year, whether consistently should he have to do audit or not is a question before us. Now, this year onwards, merely because the turnover is less than 100 lakhs and the profit is less than 6 or 8%, from this year onwards, the law never said you have to do audit. It's not necessary. 44 AD underwent a change from 16 March to 17 March. 17 March onwards, the law never said you will have to do audit compulsorily if you offer less than 8 or 6%. Condition for audit was preceding year you must have got the benefit under subsection 1 of 44 AD. This year you are working out, then get it done. 17 and block of 5 years examine, otherwise not. So 17 onwards voluntarily underwent an audit for all these years, though in all these years there is no need for him. Since in all these years he never availed subsection 1 of 44 AD, this year he is free. There is no need for audit. Because in all these 5 years, not even 1 year he has availed 44 AD subsection 1. Question of walking out does not arise. Since he doesn't walk out, subsection 4, subsection 5 of 44 AD would not apply. Therefore, class E of 44 AB equally would not apply. He can go with book results, file the return without carrying out audit. This is a firm which opted for 44 AD in the last 3 years. This year, 80 lakh rupees turnover, all received in cash. Since it has opted last year, this year at least 8% of this it has to offer, and necessarily, if not, it has to get the accounts audited. 8% of this, 80 lakhs into 8%, 6.4 lakh, but it has got only 4 lakhs. Now, if it sticks on to 4 lakh, necessarily audit is there. For the purpose of this 8 or 6% should be count before salary or after salary of interest and salary to the partner. It is after interest and salary to partner we have to count this 8 or 6%, not before, because proviso below clause 2 original subsection 2 originally gave the benefit was withdrawn, and it still remains for 44 AE only. 44 AD, 44 ADA, that percentage has to be applied after allowing interest and remuneration to partner. In respect of 44 AE, that percent, that vehicle per month, we can consider that first, and thereafter further allow interest and remuneration to partners, which is not possible in case of 44 AD and 44 ADA. Same thing, 44 ADA cases, the income should exceed basic limit. See, for 44 AD and ADA, even if the limit falls below, but income is also falling below basic limit, audit not required. But the income gross exceeds basic limit, required. But 44 ADA doesn't have that benefit. That should be factored in the mind. This is also a same scenario. Now, ABC Chartered Accountant firm, gross receipt 45 lakhs, before interest and remuneration 25 lakhs profit, after interest and remuneration 12 lakh. Now for 44 ADA, do we need to take this 50% before interest and remuneration, after interest and remuneration? It should be after interest and remuneration. 45, 50%, 22.5, 12 lakh is only profit. Therefore, audit is warranted in this case. If it is willing to offer 22.5 lakh rupees after interest and remuneration, it can go under 44 ADA. This provision is a very harsh provision. For a professional, what type of expense will be interest and remuneration to partner? Expecting an SSC to pay is 50% income after interest and remuneration to partner would be a very high number. Therefore, forcibly all the associations, majority of the associations, be forced required to get the accounts audited. Now, there are so many facets to this particular exercise, especially COVID made people to sit at home and work, and that has made so many people to also parallelly venture in the stock market with the money and screen-based trading, etc. And of course, as a result of that, many people have indulged in several types of transactions. Thanks to AAS, last year and current year, these things are coming up, and of course this nowadays partly coming up, still few more things are yet to come. At least whatever partly had come, that itself started giving us good amount of clue that the SSC has indulged in all these things. Last year when AAS came, before AAS came, the SSC just filed a salary return by consulting with the council. After AAS came, fortunate for him or fortunate for the council and unfortunate for the SSC, after filing they verified AAS again. What was not there at the time of early filing, but after July, August, September they verified. Many more transactions on share market dealings got picked up, which revealed that the SSC indulged in all these things, and that revealed, or rather that resulted in SSC filing a revised return incorporating all those numbers, which but for AAS he would not have reported. So now that is throwing open so much of new numbers. We had a practical scenario where the SSE gave everything consistently as what he did in the last years, and our AIS revealed that he has got 2 more bank accounts. In those 2 bank accounts, he has got some SB interest, and it was resulted in calling for those bank details, collecting of bank statements, discussing about debit and credit, and then incorporating those numbers in the return so as to see that there is no other outcomes likely to be after the case is picked up for hearing. So now one such case is this screen-based transactions, non-delivery based share transactions. Now, more often than not, the assessee has got lesser capital, deals with huge numbers, and thereafter the number by themselves results in a very huge number. If you start accounting the number as such in the records, but our institute guidance note says in those non-delivery based transactions, we will have to say the absolute number as turnover and not the number as such. When we do that, all the contracts which are settled together otherwise than delivery, for each contract where the otherwise than delivery, each independent contracts, the aggregate sometimes fall in plus, sometimes fall in negative. Negative value aggregate separately, positive value aggregate separately, positive numbers total, negative numbers ignore the sign and total. So now in the given example, positive numbers aggregation is 58 lakh, negative number aggregate is 60 lakh. So he ended up with 2 lakh loss. Now the turnover purpose, the negative number sign will be ignored and we will count the turnover. Now positive contracts ended up with positive numbers 58 lakh. Contracts ended up with negative, the aggregate results in 60 lakh negative. So now ignoring sign, if you total, the turnover will be 118 lakh. If 118 lakh is the turnover, but we have to report 2 lakh loss in this. That means if you prepare a profit and loss account, turnover 118 lakhs, 2 lakh loss. That means necessarily the purchase will be 120 lakh, being balancing figure. Now, if you put these numbers in ITR as well as examine the applicability of audit, it will be good. But instead of absolute number, you take actual numbers, there will be a mismatch. So therefore, we'll have to take the turnover as 118 lakhs in the absolute number terms, and we'll have to report 2 lakh loss, what he has actually lost. And then we have to take the balancing figure 120 lakh as the purchases for the purpose of keying in the data in ITR. And now when the turnover is 180 lakh, exceeding 100 lakh, less than 10 crore, definitely these cases not through cash, we can explore the possibility of availing the benefit of class A to section 44AB. So therefore, less than 5% cash dealing. Therefore, audit is not warranted in this case. But in the same share dealing division activities, assessee in the earlier year opted under 44AD subsection 1. This year he says loss altogether, not only this income, altogether for the assessee as a whole, income falls below basic limit, audit is not warranted. This activity alone loss, but all other activities result in profit and total income is above basic limit, and you would like to report a loss of 2 lakh rupees in this discussion, then audit would be warranted because he's coming out of 44AD subsection 1, which he claimed last year, and under class E of 44AB, he would be required to get the accounts audited with reference to these transactions, is what one has to keep in mind. Now, these are all certain fundamental propositions dealing with the applicability of audit. Now, before getting into the other provisions relating to classes of 3CD, I would like to spend 5 or 10 minutes, subject to organizers' living time, on any other interconnected matters on 44AB, class A or proviso, 44AD, 44ADA, 44AE. Similar to this, if at all there are queries, subject to organizers allowing 5 or 10 minutes to break the monotony, we'll take it up and then we will take up further questions. If we would like to take the questions at the end, I have no reservation. We can take it in the next round. No issue.
Sir, there is a small understanding that we need clarity on. In case of futures and options, is that a speculative transaction or not? One. The second thing is, because the futures and options transactions are mostly done through banking channel, this 10 crores limit, will it apply to it or not?
Fine. There, the proviso to class A to section 44 AB limit increases the turnover limit from 1 crore to 10 crore. All these futures option transactions are happening only through banking channel. Therefore, up to 10 crore, the number would apply. For them, that would apply, no doubt. Now, futures and options, we will have to examine exactly 43 class 5, subclass D. Now, if the transactions are such that you are able to satisfy the condition of section 43 class 5 defining speculative transaction, exception provided in class D, screen-based transaction, all that is recognized stock exchange. If that conditions are satisfied, to that extent, it will be out of speculative transaction. Not that for every such things it has to be necessarily dealt or necessarily to be considered as speculative. Not that it should be. We'll have to examine for each of the conditions, and we'll have to see if the conditions are satisfied as provided in class D of, subclass D of class 5 of section 43, then it will not be. Otherwise, commodity related transactions speculative. That condition we have to see, and the limit, as I said, 10 crore limit would apply for those cases.
Hello.
Go ahead, please.
So, for example, if a person is having just a BCom or BA degree and doing the books of accounts, maintaining books of accounts, writing the books of accounts, doing all accounting profession except tax audit, whether he can claim 44 ADA or 44 AD, sir, you want to claim profit?
Nice question, sir. Very nice question. Very nice question. Now, for the purpose of understanding this, we will put this way. 44 AA subsection 1 and subsection 2, we said this clarity would come. 44 AA subsection 1 talks about 11 professionals. 44 AA subsection 1 talks about 11 professionals. There are 7 profession mentioned in the statute, 4 subsequently notified. 44 AA subsection 2 deals with all other professionals and all businesses in the country. So, AA subsection 1, 11 specified notified professional. Subsection 2, all other profession other than these 11 and all businesses possible. Now, all businesses possible, you can go under 44 AD subject to 44 AE cases separately carved out, and commission income cases, agency business cases, remove them. All other business are eligible business except where you do not have 10A, 10AA or a chapter 6A, etc. Removing them, it is an eligible business. Now 44 AA subsection 1, 11 specified professionals will come under 44 ADA. 44 AA subsection 1, 11 professionals will come under 44 ADA. Less than 50 lakh income, gross receipt, what's that? Else audit. Above 50 lakh income, gross receipt, audit mandatory under 44 AB class B. So this 11 professional, less than 50 lakh gross receipt, at least 50% income, go by 44 ADA. Less than 50% income, audit under 44 AB class D. Above 50 lakh gross receipts, audit under 44 AB class B. Now, other than this 11 professionals, all other professionals, 44 ADA would not apply to them. Less than 50 lakhs, they can go with book results. Above 50 lakh, 44 AB class B will apply because they are profession. So, profession is now divided into 2: specified notified profession, all other profession. Whether specified notified profession or all other profession, all of them above 50 audit warranted under 44 AB class B. Below 50, less than 50% audit warranted only for these 11 cases. Below 50, all other profession, below 50, because less than 50% audit not warranted for all other cases because they are 44A subsection 2. So 11 profession, accountancy, company secretary, interior decoration, technical consultancy, all these cases coming under that 11 profession. Less than 50% audit, up to 50 lakh, above 50 lakh mandatory audit. Now question arises, having given this prelude, profession exceeding 50 lakh, always audit. Below 50 lakh, 50% above for 11 cases, no audit. 50% below for 11 cases, audit. For other cases, irrespective of percentage, no audit. Keeping this prelude in mind, now we will see whether the profession of accountancy by itself require us to say there must be a qualification in order to say you should regard yourself under 44AA subsection 1 and get the benefit of 44ADA, or without a professional qualification or a basic qualification like BCom, BBA, BBM, etc., doing the accountancy profession would be sufficient. In my personal view, a professional qualification like cost accountant or a chartered accountant is not warranted because 2 clause 36 says profession includes vocation. Therefore, that is sufficient. Therefore, that gentleman, without doing tax audit, he will come under profession of accountancy. Less than 50 lakh, 50% he offers under 44 ADA, fine. If not, he has to maintain books and get the accounts audited. He will not come under other profession. He will come under this 11 profession only. Therefore, less than 50 lakh, 50% mandatory, failing which audit is necessary. More than 50 lakh, anyway audit is necessary.
Sir, good evening, sir. Sir, I have one question. Am I audible?
You're audible, sir, please.
Thank you, sir. Sir, a partnership firm having a turnover around 1.5 crores, but it is engaged in the business of consultancy, which in turn receives commission from abroad. So, anyway, these are out of scope of 44A, but their cash receipts are, not cash receipts, their receipts are 95% in bank receipts only, there is no cash receipt. So, only cash transaction that is present is the cash deposit. So, what is the stand of 44AB in this case?
So it is if I understand the facts clearly, there is a firm which is indulging in certain consultancy but getting commission.
Yes.
Consultancy resulting in commission is something very difficult to gel with. Either it's a commission case or consultancy receipts. We will have to examine the facts slightly.
Because their primary income is commission.
Let us say it is a commission. Instead of consultancy, for understanding purpose, we'll say commission. Assessee engaged in commission will not be entitled to come under 44 AD. It gets ousted.
Yes.
We will have to see 44 AB class A. Class A up to 1 crore rupees, no problem. Gross receipt crossing 1 crore, and we will have to see up to 10 crore. It is less than 5% cash dealing, no problem. So receipts are all check, no issue. Coming to payment side, you claim that bank deposits are made, cash remitted into bank. Is there a question, right?
Yes.
Now, where from the cash has come? You say cash has remitted into bank. Who has given the cash?
So it's a withdrawal from the bank and later deposited in the bank.
Fine. In that case, you originally got a receipt.
Yes.
That as a bank receipt. Subsequently, own withdrawal and remittance back. That yes. Both of them are neither receipt nor payment because it's your own money. Instead of keeping at home, you are keeping in bank and reversing vice versa. This number has to be excluded for the purpose of calculating 5%.
Okay.
Remittance into bank and withdrawal from bank, that has to be excluded because it's your own money. Neither you are receiving nor you are paying. Therefore, that has to be excluded. If you having excluded, balance transaction falls below 5%, audit is not warranted.
Okay. Thank you.
Hello. Hi, sir.
Yes, sir.
Sir, one of my clients is engaged in pawnbroking. So their net margin is actually more than 80%. If you see overall turnover, it is less than 1 crore. But if you see the margin is more than 80%, can they go for 44 AD, sir?
Nothing prevents them to go under 44 AD, sir. But only thing is you will have to report the actual income. Say book says 80% margin. The margin so earned represented by either incremental debtors or investments or withdrawal by the proprietor for personal investment like purchase of land or investing in shares or jewelry, etc. But still the assessee says I'll offer 8% or 10%, 15%, he will land into trouble. He can go under 4480, but we'll have to link the current year investment with opening balance sheet, closing balance sheet. Even in abridged form, we will have to prepare opening and closing balance sheet. See the fund flow, the income offered plus depreciation, if any. Aggregated number should match with the flow. The actual income earned, invested in various assets compared to last year is far more than the income reported in the return plus the depreciation. Then to that extent, it will be a case the assessee has offered lesser income than what he has earned. To that extent, he will be in trouble. The numbers are very, very sizably high. The danger will be not be treated as income earned from this. It will be unaccounted, not unaccounted income of this business. It will be treated as undisclosed income of unknown source. There the rate of tax will be 115 BP.
In this case, everything is accounted.
Okay.
Everything is linked through bank account. His interest income is around 80 lakhs. But the case, the 4480 specifically says you can offer 8% and still you can file the return.
No, 4480 says you can offer 8%. That doesn't give an insurance or a guarantee that even if your income is more, you can offer 8 and we'll leave you.
Okay.
That doesn't say so. So if you are offering 8%, law will presume you have spent 92%. They will not ask you where you have spent 92%. But if they ask you to reconcile your bank balance, assets, etc., and you are unable to reconcile with the existing income offered plus depreciation, to that extent, you have earned income suppressed. And if the suppression is so very high, then it will result in landing into the income not coming out of this. It is, see, 1 or 2 years, it continues, and third year, the assessee invests in a larger investment. He accumulates cash and larger investment is made. That year will be treated as unexplained investment, the year in which he purchases land, purchases building. That year, if you say it's income only from pawnbroking business, the margin would not be sufficient to be looking normal. It will be abnormal for that year. Let me just take a practical case. 2 years he accumulates the revenue. Third year, April month, he purchases that money. With that money, he purchases. Within April, you would not have earned that much money. Then revenue will say, your pawnbroking, I'll say 30%, 40%, rest all unexplained investment. 115 BB you would apply. Then the effective rate will be, 60% plus 25% surcharge there on 75 plus 4% education charge 78. And thereafter, 234B, then 6% penalty. So that would land the assessee in trouble later on. So even if the assessee goes under 44 AD or ADA or AE, it is ideal to reconcile the opening and closing balance sheet with the depreciation as the cash accrual, ascertain how much is the cash available, and see whether they are properly invested so that later on the assessee will not be in trouble. Otherwise, it will be very lucrative at the initial stage. The assessee keeps growing and getting the attention drawn. That day, he will have to shell out much more than what he has earned and saved.
Thank you, sir.
Sir, nowadays, many people are indulging in the stockbroking activities wherein they are liable for tax audit. Unknowingly, they are crossing the turnover of 2 crores, 3 crores sometimes. So when they are getting the books audited, I know this might be a layman question, but they might have a personal bank accounts wherein they just transfer the money from any account just like that. So when are we supposed to enter all the bank accounts in the books? Because there will be so many entries, be it their credit card, with their personal bank accounts. So everything will be in the personal ledger except 1 or 2 in the middle, which is relevant to that particular business. So how do we handle that situation?
Very practical question, sir. We will evaluate the bank account. The bank account which has got highest number of business transaction will book it in the business books. Bank account which has got seldom business transaction, majoritarily personal transaction, we'll keep it away. That 1 or 2 transaction through capital or current account will route through in the business books. And that much will confine to. The other, suppose 100 transactions are there, only 5 or 6 are business. That bank account will keep it outside. And only that 5 or 6 transactions will record in the business books and get that audited. That's all. Routing through capital. That entire bank account, which has got 90% entries relating to other than business, need not be included in the business books.
Okay. Thank you, sir. Thank you.
Can we move to the remaining areas and reserve the questions at the end?
Yes, sir.
Fine. Now we'll come to classes of section 40, classes of 3CD and associated issues. Of course, as at the beginning it was mentioned, we will spend some time on the 44, class 44 in detail at a later stage, but some other matters also requires attention. Therefore, we'll take that also side by side, and finally we'll wrap it up. Now, TAQRB, Taxation Audit Quality Review Board, mentioned many things worth once again referring to the same. Fundamentally, in a places like what we are now discussing with, the business people believe that auditor would take care of many things, and the ignorance of the business people or the level of understanding of the accountants all would pose onerous responsibility on the professional, and the interest of the professional in ensuring that the assay doesn't get caught later on. And our profession is the one which has gone overboard to ensure that the assessee doesn't land into difficulty, even though the assessee doesn't understand. Our profession traveled a lot in protecting the interest of the assessee. That's the reason why our profession still commands good respect, because sometimes even their ignorance, we do not allow them to lose because of their ignorance. We go one step up and then ensure that the assessee gets the relevant benefit what he is otherwise entitled to, even if he is not aware of. To that extent, we work for the profession, for the assessee concerned. And many occasions, this results in sometimes, many occasions, I should say, not sometimes, many occasions, this particular scenario, sometimes the lessment record required to be drawn is not drawn, and it lands the auditor in trouble. So what we need to keep it in our mind, audit report under 3CD is statement of particulars. Audit report, what we are giving is 3CA or 3CB. They are audit reports. Statement of particulars is given in 3CD, which has got certain specific information to be provided. As we all know, audit is something where we are expressing an opinion on the financial statements appended. But required particulars independently, we'll have to examine the correctness of the information furnished and we'll have to attach. Earlier it was manual, now we are giving through electronic form. So on audit report, materiality matters, because the user of the financial statement, if there is a small error, may not alter his decision-making process because of an error. Therefore, materiality matters. But when it comes to the information furnished in 3CD, the factual accuracy of the same is required to be established, because 3CA, 3CB audit report. 3CD is not audit report. It is statement of particulars verified by us. So that means we are verifying who is providing the data. Technically and theoretically, it is the assessee who provides the data. We are verifying the correctness of the same. So the primary responsibility of providing the accurate data in form number 3CD is on the assessee. Our responsibility is only to verify the correctness of the data so furnished. So in real life scenario, we help the assessee in culling out the data and correctly furnishing it in 3CD. But theoretically, it is the primary responsibility of the assessee to provide it. Our job is only to verify the correctness of the same. And there are a number of classes where our guidance note, our institute guidance note says you can do test checking, but say you have done a test checking. If it is done, then you have adequate documentation that these are the classes for which we have done test checking and we have gone with that, more than sufficient. But we will have to now demonstrate that assessee has provided this, we have done test checking, we satisfied ourselves. Therefore, get the management representation letter. Along with that, one copy of form number 3CD signed by the management as an annexure to MRL. Keep it with you as working paper. Later on, if something goes not as anticipated. At least this working paper, this MRL, one copy of 3CD and our audit working paper would help to say, this is what the SSC has given. We have done the audit based on our institute pronouncements, and therefore we have completed like this. One or two things, these are that way, materiality, at least some difference we can take. So therefore, it is better to collect one copy of 3CD duly signed by the management and keep it in our record. That is very, very important in order to at least safeguard our interest at a later stage. Why we say so? Materiality concept would apply for audit reports. For statement of particulars, materiality would not come, because in audit report, we say the accounts are true and fair. But when it comes to the information furnished or particular furnished in form number 3CD, we say, in our opinion and to the best of our information, according to the examination of the books of account, including other relevant documents and explanation given to us, the particulars given in the said form 3CD are true and correct. We say true and correct, not true and fair. That means factual accuracy has to be necessarily ensured. The factual accuracy necessarily has to be ensured. Now, there are so many combinations we may come up with. If there are certain classes where the assessee says if the class is drafted like this, it will help him. But as professionals, we would like to put our view differently. But if our view is incorporated, the assessee may find it discomfortable, but we'll have to satisfy ourselves, and assessee would like to satisfy his own case. In that case, how shall we protect the respective interest of the respective parties? There, as I said already, the prerogative of furnishing information in SAS 3CD is that of the assessee. He gives everything. If assessee agrees for our comment, we are altering. If the assessee doesn't agree, he sticks on to his comment, then we will have to say this particular clause he has mentioned like this, we are not acceptable to that. Where will we say that? Para 3 of form 3CA or para 5 of form number 3CB. These are the two places we will have to say. I'll just give one example to appreciate this aspect. Mr. X SSE borrowed money from Mr. A. During the financial year, Mr. A passed away, and his son, Mr. A's son B, comes and says, according to the will of my father, this amount he has given to you belongs to me as per our family understanding, as well as the will given by the father. So therefore, change that loan from my father's name to my name and start paying interest to me. Now, X passes a journal entry in the books, 10 lakh rupees loan receipt. The father's name is squared up, son's name is created. A's account debtor to B account 10 lakh rupees. Now, we are filling up clause 31 of form number 3CD. According to the assessee, the receipt of 10 lakh from son, closing of 10 lakh loan to father, both are not in violation of form number, violation of 269 SS or T. Therefore, nothing is required to be reported. But section says you accept money or you repay money otherwise than account pay check, draft, ECS mode, it is required to be reported. You may rely on certain judgments to say they are not technically liable to be penalized, but whether to inform or not to inform. Now, assessee is of the view, if you inform, you say son's name, 10 lakh received, maximum balance 10 lakh, mode, neither account pay check, nor account pay cross draft, nor ECS, IMPS, NEFT, RTGS, finally others. You put others, then system will pick it up and say it is amounting to violation. 271 D notice would come. Father's loan closed, name, permanent account number, amount closed, maximum balance outstanding, and mode in which it is closed. You put others, 271A notice will come. Say for assessee says, I will not report here. But as auditor, we are required to mention that class 31, subclass A, B, C, this information is missing. Where to say this? Form number 3CA, para 3. Form number 3CB, para 5. We will have to say this. What to say? In class number 31, according to SC, a loan borrowed by closing another loan by way of a journal entry is not required to be reported because there is no column to provide for journal entry cases. Therefore, the SC did not furnish such information. This is what we will have to mention in para 5 of 3CB or para 3 of 3CA, so that we will safeguard our interest. Earlier, these classes were not there to report. Now the classes are permitting us. At least we can report this. And assessee would like to continue to report what you would like to say. To that extent, this para 3 of 3CA, para 5 of 3CB would come for our help. But if the number itself is altered, then system will pick it up for 143 subsection 1 clause A. Any disallowance expenditure indicated in the audit report but not taken into account. Similarly, penal consequences related matters 271 DE, DA, etc. From the information furnished in audit report, it will pick up. Therefore, in number, if there is something mentioned which will lead to problem, assessee may take a shelter to say, I would not like to give this. In those cases, we will have to protect our interest by specifically mentioning that para 3 of 3CA, para 5 of 3CB, specifically we will have to mention that classes are not properly filled up, or this information required to be given is not filled up because assessee is of the view that this is not required to be reported. Now, class 1 to 8A, certain basic things, name, address, permanent account number, all that. Now, address related matters, what to report, whether personal address or whether proprietary cases, the issue would come up, address, whether residential address or the business address. I always used to say business address is ideal. Personal address sometimes may land them into difficulty. Then on the balance sheet date, he has got one address. On the date of signing the audit report, he has got another address. Which address will have to report? Balance sheet date, signing the balance sheet date. The later address we'll have to give because it is the address to which we need to have communication. Therefore, the old address not required. The later address, later part, whatever he has moved, that address is required to be reported. And for ROC, we will have to check where companies, where ROC records, what is the registered office, other office where books are maintained, we will have to check and give. And it is ideal to cross-verify IT PAN card, profile page of the IT department, the software used by our office for uploading the return of the SSC, and office records of the tax auditor, all will better synchronize together. Class 4 of the form number 3CD requires the indirect tax registration details. Earlier we had so many things, post GST, they are all subsumed into few. So the registration details to be given. For customs, IE code, now permanent account number, previous time it is IE code number has to be given. The assessee has not obtained, although his levy is attracting levy, guidance note says you will have to say the fact that he has not obtained it. That is something we will have to say. Now, class 11 talks about books and documents. Prescribed, again, 44 AA subsection 1, 11 cases. 44 AA subsection 2, all other business, all other profession, all business. For all other profession and all business, books are not prescribed. 11 professionals, books are prescribed in Rule 6F. So now we will have to, for audit of these 11 cases, we will have to say what books are prescribed as per Rule F. All other profession and all business, we should say not prescribed yet. There are cases for corporates. For corporates, books prescribed is mentioned. In some of the audit report is what TAQRB noted. Corporates doing business. When they are doing business, they'll come under 44 AA subsection 2. Books are not prescribed. For them under prescribed column, nothing should be mentioned. Only for 11 specified professionals, prescribed data we have to give. For others, we should say not prescribed yet. Now coming to books, documents maintained. Now maintained, if more than one place, we'll have to say all places where it is reported. We'll have to report all places where it is mentioned. Not only address, in each address, what records are maintained. Address wise record we will have to capture and we will have to say. Now, better to have a clarity on this. Sometimes Section 133A enables the income tax authority to carry out survey. In a business premises during business hours, they can come. In a place where assets or books kept, which is other than business premises, the survey authorities can come after sunrise but before sunset. Now, if the assessee in tax audit report says, I have got books maintained in these 4 places, out of that 1 place is business, the remaining 3 are not business places. If the assessee is liable for an action under 133A, now department would attack all the 4 premises, in which 1 is business premises during business hours, they would come. Remaining 3 not business premises, go down. Accounting, register, that administrative office where accounts are kept. After sunrise, before sunset, they can come. So therefore, this particular clause 11B would help to gather the information. Therefore, we will have to carefully collect information from the assessee, verify the correctness of the same, the places where business carried on, records maintained, and all other premises where records are maintained, like factory, registered office, go down, records maintained at different places, we'll have to collate and give properly. Then examined by us. So prescribed by the statute, maintained by assessee, examined by us. We will have to say what are the books examined by us. Also, we have to say what other relevant documents examined by us. That's something where the list is going to be endless. Books examined by us, we can say. If documents are examined something, what list we can give? We can continue to give as much as we can. But we have to draw the line. The primary documents to support the entries made in the books, that primary document we have to say. But we rely on certain surrounding evidences. We can give that also. For that, there is no mandatory requirement. You can decide, professional judgment can help. Sales voucher is a primary document, sales invoice. But GST invoice we verify, or GST returns we verify. Then they are secondary documents to cross verify. That also can be added. So confirmation of sundry data to verify this. Stock records to verify this. These evidences, other evidences what we rely on just to support that, list could be endless, but the primary document for the purpose of establishing the correctness of the entry made in books, that has to be reported. Secondary documents we can keep adding subject to whatever we have seen. There is no bar. Now, we'll come into the other classes available. Instead of going class after class, I would like to take up in a different order. First, I'll take up the liability side of the balance sheet we are auditing and pick up relevant classes. The liability side, loan, class 31. We have already picked up one example where we are discussing the para 3 of form 3CA, 5 of 3CB. Now, understanding of this particular class 31 leads to understanding of the applicability of the provisions of section 216 SS T ST. Now, 216 SS and T talks about loan deposit specified sum. For loan deposit sum for 216 SS, 216 T loan deposit specified advance. Ceiling is 20,000. Question arises whether it is 20,000 or less than 20,000. In 40A3, the section uses the language exceeding 10,000. That means up to 10,000, okay. For the purpose of 216 SST, the ceiling is 20,000, section gets attracted. That means 19,999 permissible. 20,000 gets hit. How the ceiling has to be reckoned? Per annum, per month, per day, per transaction, or more than per year, including opening balance, we have to see. A simple rule can be coined to decide about the applicability. When we receive money, under loan, deposit, specified sum. Before receiving money, we'll see the balance. The balance, before receiving the money, the balance is already touched or crossed 20,000. even 1 rupee subsequently we receive, that should be through account pay check. If the balance doesn't touch 20,000, 19,500, whatever we receive now, because of this quantum, the closing balance either touches or crosses 20,000. This transaction should be through account pay check or draft of ECS. 19,500 we have received opening before this transaction. This transaction 500 rupees. That means total closing balance touches 20,000. Therefore, this should be through account pay check or draft or ECS. Opening balance is less than 20,000. Because of this transaction, closing balance also less than 20,000. So 19,500, 250 received now. Closing balance 19,750. Therefore, it can be either cash or non-cash. So if the opening balance has already touched or crossed 20, this transaction should be only through instrument. Opening balance is less, but the closing balance touches or crosses, then it should be through instrument. If the opening balance and closing balance of this transaction, for this transaction, opening balance and after the transaction, both is less than 20,000, transaction can be either way. This is for the receipt part. Now for the payment part, before making payment, see the balance. The balance has already touched or crossed 20,000. This payment, irrespective of should be through instrument. If the before making payment, the transaction closing balance before making the payment is less than 20, this transaction can be in any mode. This is the golden rule to apply 216SS, 216T for the purpose of specified sum, specified advance, loan or deposit. Something one we have to keep it. Now, ECS has become a permitted mode. Now, when we are discussing about repayment, previously only one clause was there. Repayment, we have to say. Now, the repayment has further divided. You repay, but you receive in the cash and repay. Explain separately. Received other than cash, but other than account pay. You receive during the year, repay. So, repayment, all repayment, whether received current year, received preceding year, we have to say first. Out of that, how much we repaid out of the current year receipts. The current year receipts received in cash, received through instrument other than account pay, but paid. A payment can be differently made through account pay, but receipt other than account pay or other than or cash, that has to be carved out separately, is what two additional clauses introduced. 216 ST. Very interestingly, from 17, this has come 2 lakh rupees. So touching 2 lakh or crossing 2 lakh, the transaction comes. 216 ST was made applicable to be reported for all the reports made after 28, 2018. Now we had 4 subclauses, 2 receipt dealing with the receipt, 2 receiving payment. Now the section per se applies only for the recipient of money. Payer is not worried about the section. The other person is only caught. But even though section talks only about the recipient of 216 ST, clause number 51 talks about recipient as well as payer. If this assessee pays 2 lakh or above in cash, though 216 ST not apply for this assessee, this has to be reported by him, which will enable the department to proceed against the recipient part. So one has to call out information in terms of as well as payment in this particular class. And exceptions provided in section, exception provided in the notification have to be factored while dealing with the reporting part of it. Circulars issued subsequently clarifying about the applicability of section 269 ST should also be borne in mind. House finance companies, installment 2 lakh or for the balance of loan itself 2 lakh. What's the question? Where the circular said, if the each installment value is falling below 2 lakh, though the loan value is above 2 lakh, 269 SC would not apply. So that circular can have a bearing when deciding about the installment being less than 2 lakh, not required to be reported. And some you further prevails to say when housing finance companies can take this benefit. Why not hire purchase organizations? Why not NBFCs? Why not loan parties? Of course, one can rely on it and of course extend the theory subject to the risk, but better for our audit report, let us say ASSI relies on this circular. And if this particular clause 31 peculiarly worded in such a fashion that even if the assessee complied with the law, we have to report. He is received through ECS. He has repaid through ECS. Still, we are required to report. Now he has received 5 loans during the year, and he has got opening balance of 5 loans. And now 10 loans, out of that 4 loans he has repaid, balance, closing balance. All are in accordance with the law. Still, class 31 is required to be reported. All this we have to report. There is no exception. For a smaller case, fine. If an assessee is engaged in getting deposits, an MBFC deposit, and then giving loans, now he has followed the law. But if you start reporting, it will be voluminous. So in those cases, our institute guidance note says the purpose of giving information in class 31 is to enable the department to know where things are not followed properly. So in those cases, we can say the assessee has taken a view that only defaulting cases have to be reported. Where they have complied with the law, it is not required to be reported. Accordingly, class 31 is prepared and furnished. So that is something one can rely on. Not that entire data is required to be reported. We have to report only the defaulting cases, but we have to draw attention in para 3 of 3CA, para 5 of 3CB. And since the volume is heavy, we can always rely on disclaimer. We can always go for test check. And that test check, we have to document properly. If that test check is also not possible, then disclaimer is the only way we can safeguard ourselves. Now, there are few interesting practical aspects. Transaction between husband and wife, whether it would invite 216 SST. Transaction between parents, son, daughter, whether it would invite 216 SSNT. Husband and wife, technically the section doesn't give exception. In other words, when 48.3a, we have exception mentioned in rule 6DD. Similar to that, for 216 SS and T, there is no detailed exceptions provided. So therefore, technically section would apply. The assessee is a proprietor. He received money from his spouse, and that particular entry is found in the business books, and it is in cash. Then can the assessee say it's between husband and wife, and therefore it is not required to be considered under 216 SS and T? Technically, section would apply. But interestingly, courts have come for the rescue to the seat to say the purpose of this section is to only see that people do not route their black money in somebody's name. When the sources are available in wife status and assessee uses the money for the benefit of the family, nothing prevents them to use it, and therefore section should not be used. So technically section is applicable, but court may come for the rescue. Now it's a proprietary business. Assessee accounts in his personal book. He takes money from his wife in personal book. In business books, he introduces this as his capital. Now our job is to verify only the business books. Our job is not to verify his personal transaction. We may help the assessee in preparing his personal return, but our job as tax auditor confines to the entries found in the business books. In the business books, there is a capital credit. That's all he introduces. Therefore, in 216 SS or T, this will not figure out. But if capital source is asked, he has to say he has received from wife, and his wife's balance sheet, income tax statement, etc. he has to come up with. And that may throw open 216 SS and T, then yes, he can bail out saying it's a family fund. But if it is found in the business books, and the assessee doesn't report it, and the assessee doesn't want to report it, but it's a cash transaction in the name of wife itself introduced, then only option available for us is to report in para 3 of 3C or para 5 of 3CB, as the case may be. Similar is the scenario for parents and daughter. Then retiring partners balance payable. Practical scenario. Middle of the year, the 1 or 2 partners may retire. Balance outstanding. Our accounting professors in the earlier days of our accounting taught that it has to be transferred to loan account. So in the books of account, the retiring partners outstanding balance shifted from capital account to loan account. Afterwards, whenever business had physical money, the partners settled to the retiring partner loan account by paying cash. Now, when he was a partner, he is entitled to take the money in cash. Once he ceases to be a partner, afterwards, when he draws money from the firm and the account is written to say it's a retiring partner loan account, and the balance outstanding exceeds 20,000 or more, even 1 rupee paid in that account should be only through account payee. Otherwise, it requires to be reported. So if the accounts is shown as loan payable, reporting is warranted. But if it is shown as other current liability, it is not taking the character of loan account, then 269 SST, etc. may not apply. To that extent, we can escape. So nomenclature is very relevant, how partners would like to regard this, whether it's a loan received payable to the retiring partner or it's only an outstanding balance required to be paid. Depending on how they present in the books, the treatment would vary. Direct current account in a left, right, center, money coming and going. Of course, courts have said this is a running account, therefore 216 SST would not apply. Closing loan by journal entries, I have already explained. Technically, section would apply, but the ASI may rely that certain judgments like Delhi High Court, etc., to say this will not be required to be reported, in which case we will have to draw attention in para 3 of 3CA, para 5 of 3CB. Whether all transactions through account pay required to be reported are only violation cases, our institute guidance note says where intention is only to report on violation, even though the form is drafted to report everything, going by the purpose, we can go only to report violation cases. If the assessee borrows money in cash, say 1 lakh rupees, subsequently he repays 1 lakh in cash, both have to be reported? Yes. When we report both, yes, been visited with penalty for the first transaction. Second, repayment, 1 lakh received in cash, 1 lakh penalty. 1 lakh repaid, can there be penalty for the second transaction? He has already suffered penalty for the first transaction. Merely because for the first transaction he was visited with penalty, that will not absolve him from paying penalty for the second transaction. Accepting deposit or receiving loan is one offense. Repaying loan is another one. Merely for the reason that first time he has visited with penalty, that by itself is not a ground. For the second round, it will not apply. So therefore, ASIC cannot take that plea. That will be a miserably failing case. One has to be careful about. And section 269 SS versus 68. The assessee has borrowed money in cash. 269 SS comes. And in the hearing, he could not explain it properly. Therefore, the department invokes section 68. Now, can the department say, it's your money, I'll tax you under 68. And at the same time, you have borrowed in cash, therefore I levy a penalty. Both are not possible. Either the department should say, yes, it's your money, you have not borrowed. Or it's not your money, you have borrowed. But you have borrowed in cash, therefore penalty. Or it is your money, you are introducing somebody's name, therefore it's your income. Tax the income concerned. Both are not possible. Can genuineness be the defense? That's an interesting proposition. There are some rulings to say the purpose of this section is not to penalize the assessees on a technical ground. If the assessee is able to demonstrate it's a genuine transaction, but for some external reasons he could not comply with the law, it has to be allowed. There are few other rulings to say section 216 SS would apply only for a genuine transaction. For the reason that it is genuine, you want them to be bailed out, for which other case section 216 SS would apply. So genuineness cannot be always a basic defense to get out of 216 SS. If it is a bogus transaction, 216 SS will never apply. Section 68 only would apply. So if it's a genuine transaction, that by itself would not be a ground to argue that the assessee should be exempt from or to be liberated from the application of 216 SS. Better, instead of genuineness being treated as defense, always ideal to say compulsion. The business compulsion made him to get the cash on that day. That would be the better case rather than saying that other person also accounted, I also accounted, the transaction is genuine, therefore penalty should not be levied. That sometimes may not help the case of the assessee. That's with reference to liability side. Now we come to the income side. Class 12, presumptive income credited to P&L account. When class 12 was originally drafted, we have 44 AD, 44 ADA, 44 AD AEAF. Therefore, the language was such that what is the presumptive income included in the P&L account? There could be other businesses for which you are doing audit. Today, 44 AD encompasses within itself other than 44 AE everything. So therefore, we will have to suitably keep this background in mind and start filling up class 12. Income covered by presumptive income included in the profit and loss account. Suppose one portion of it available. Let us say agency business. as he's doing audit. In the same business, he has got cross 44 AD. Included, we have to exclude. The agency is not there. All 44 AD cases, we have to aggregate. Question of partly coming this way, partly coming the other way, it's not possible. How much is the eligible presumptive income? We need not say. How much is the actual income of that presumptive activity included in the profit and loss account? We have to say. And books are separately maintained, fine, on presumptive, non-presumptive cases, and aggregated P&L account prepared, no issue. Otherwise, the expenses required to be apportioned between the two in order to make the correct profit and loss account. Now, clause 13 talks about other income not credited to profit and loss account, where a list is there. Item covered by section 28, duty drawback, capital receipts, escalation claims, any other income. Practically, one of the initial remarks very nicely captured this point. After the advent of CPC, we are unable to comprehend certain things as to how CPC read this, and that results in certain unintended developments or incomprehensible outcomes. And thereafter, we have to chase as to how we have to address this. This is one light case. Interestingly, a proprietor in his business books accounted the personal bank account as well. So he has received rental income, SB account interest, and one vacant land sale. Consciously, to make the business profit clear, the rental income received, capital gain, the profit on sale of asset, and the SB interest, what he has received, he has directly taken to the credit of capital account. So profit of the business is properly accounted. Now, on examining the books, the rental receipts, capital gain component, interest on SB, auditor has reported under clause 13, other income not credited to profit and loss account. While filing the return, rental income properly reported under the head house property, the capital gain properly reported, then interest on SB account properly reported. Now, auditor report says this income not found credited in the profit and loss account. Recent notices from CPC say audit report says this income is not credited to profit and loss account. Therefore, we are proposing to add. System is unable to reconcile this with the income already offered under other heads. Auditor says you have not reported this in the profit and loss account. Therefore, we are adding it to a computation of business income. The auditor thought these are income, although offered under other head, not credited to P&L, therefore he is reporting. That was not the way law is understood by CPC while codifying the law. Clause 13 is read, other income otherwise required to be taxed under the head business, but not credited to P&L account, has to be reported by auditor. If the income is of such nature which is otherwise included in other respective heads, but taken to the capital account, is not required to be reported at all under clause 13. If inadvertently it is reported so, notices would come from CPC prescribing or proposing to add such income. How many number of times we mention about the fact that it is already reported under the head house property or under the head capital gains or other sources, that is not going to really help. So therefore, one way, cases where it is already done, it has to be, audit report has to be revised. Else the option could be to file an appeal, revision, rectification, etc. Very difficult. The better to file a revised report to get out of it. One way. Other way, take it to the credit of P&L account, rental income, SB interest, profit on sale of asset. In the computation, considered separately under other heads, remove from profit and consider, so that the system will link it properly. Either don't report under clause 13 or route it through profit and loss account, so that it will help you to make the case comfortable. And principal waiver of the loan, Mahendra and Mahendra 404 ITR Supreme Court, page number 1, is not an income. 224.18 would not apply, and 28.4 would not apply, 41.1 would not apply, 56.2 would not apply. And therefore, of course, tomorrow 194R, one issue where board is approached about this. Otherwise than that, there is no taxability part of it. Therefore, it is not required to be considered as other income. There is some OTS on a principal component, there is a waiver that is not required to be considered under other income. Next comes certain clauses dealing with deemed income. Property related transaction, land or building or both, covered under 50C or 43CA. Clause 17 talks about it. Now, from the seller's perspective, clause 17 talks about it. What does it say? Land or building or both transacted at a price less than the stamp duty value. Cap is falling less than 10%, nothing to worry. About 10%, excepting for a period where that percentage tolerance increased from 10% to 20% during COVID time. Leaving that, generally 10% stands now. So if the tolerance is less than 10%, no worry. Tolerance is more than 10%, then necessarily liability arises for the deemed income. Now, if it's a business case, assessee dealing in the land or building or both, then 43CA is the enabling provision to tax it. If assessee is not indulging in business activity, he is doing some other business, partnership firm, doing some other business. Partnership has got one land that is sold. Now 50C will come for them. There we have to report under clause 17. Now let us take a proprietor. Proprietor business is there. For the same proprietor, we help the assessee in preparing his return of income. Therefore, we know that there is a capital gain transaction, but it is not in business books. He has got a separate personal bank account in which he received consideration that is falling less than the stamp duty value. Under clause 17, it is not required to be reported. It is not required to be reported because what is to be reported is only as per books. It is not required to be reported because that clause will not apply for a personal transaction, although we are aware about the transaction. We are not required to report as an auditor. No, we are primarily dependent on the softwares, Winman, CompuSoft, and so many other softwares in the market. Some of the information is picked up from the ITR into tax audit report voluntarily. Now, in the ITR, we give firm number that 50C related information, it gets automatically picked up. An individual for whom we are preparing the return and also we are doing audit of business books. Once we prepare the return, the clause 17 will get automatically picked up from the information furnished in ITR. So now how can we say not applicable for personal transactions? We are not required to report it because it is not forming part of business books. System get that the software is picking up automatically. So how to break this? Carefully one has to do. That case, that Winman, CompuSoft, Taxman, or whatever software you are using, that year we'll have to have two Compu files. Computation related files, we should have two. One for audit report, one for computation. In computation, we'll have 50C related information. For uploading audit report, for that year, that file, this particular 50C computation portion will remove. Save this. 3CB, 3CD alone will upload from this. ITR will upload from this. If you do that, this inconsistency can be avoided. But the junior who is doing it should be very careful. If he is going to upload 3CD from this particular file and ITR from this file, that is going to be really a nightmarish exercise. So to achieve this, that year we should have two tax files, one for uploading ITR, another one for uploading tax audit report. For tax audit report cases, personal related information first we should weed out from computation, finish tax audit, forms, upload, save it separately, and that other one make it clear so that this particular dichotomy can be avoided. And business cases, 43CA, automatically it is required to be reported, nothing to worry much on it. Then comes agreement versus actual transaction. Of course, section has got so much of differences where because of timing factor, there is some problem that could be neutralized because of the section. Tolerance, 10%. Tribunals, Mumbai ITIT says, since government realized the difficulty, gave 10%. The day section 50C came, the 10% can be said to be incorporated. Though originally 0%, subsequently 5%, subsequently 10%. Tribunal says that 10% you can try. Date it back to 2002 when the original section came. All the pending cases, 10% variation, you have nothing to worry about. So this is something one has to carefully use it. But From audit perspective, these defenses of 10% tolerance, etc., is different. If it is a business transaction, it will come. Personal transaction for a partnership, AOP, company, 50C will come. For proprietor of a sole proprietor case or a HUF doing business in case, personal transactions, it will not figure out in class 17. Now, instead of the seller's case, we go to buyer's case. Then comes 56 to 10. Then comes 56 to 10. From buyer's perspective, if the asset, namely land or building or both, received less than the stamp duty value, income comes. He has to report under 56 to 10. Now, same example, individual received a property for a price less than the SDV. We are helping him in preparing the return. It is an income which is required to be reported under other sources, but it is not required to be reported under class 29B if it is kept outside books. But if it's a partnership firm or a limited company, transaction is figured out in the business books, then we have to report under class 29B. That important factor of auditing books and giving information out of that in form number 3CD has to be borne in mind. Now there are three important changes came in the law. Forfeiture of money received on transfer of capital asset, a deemed income. Business books, what is found in business book, treated as income. Specified assets are money received without consideration or for inadequate consideration by any person from any person other than relatives or some specified personalities, income. It has to be considered as income. Again, business books, again, underlying factor is business books. For that matter, specified assets and money, only 10 items covered. Motor car is not covered. So therefore, law would like to say, if you receive these assets for a price less than its consideration, only then, or less than its fair market value, the section would get triggered. Other things are not there. Deemed dividend, as per 222E, class 36A, it has to be reported. Specifically, one has to make it up. Then comes expenses side. So we have seen liability side, then income side. Now comes expenses side. Many number of aspects could be discussed in detail, but of course, I'll quickly say expenses side, welfare contributions, employee share within due date, or 139(1) due date or respective due date of the respective statute. Amendment came to say we'll have to give only respective due date of the respective statute, 15th of the succeeding calendar month for employee contribution. Employer contribution, it can be up to 139(1). Past years, before it came, the rulings are there to say even the employee contribution could also be allowed up to the due date of filing return of income. After the amendment also, the tribunal judgment, Hyderabad tribunal judgment went on to say immediately after the amendment came somewhere in the May month to say the amendment is prospective. Therefore, past years are not going to be affected. But as audit perspective, respective due date of the respective statute, we have to give in class 20B. The assessee is adventurous enough to put 139(1) due date. We have to report it in form number 3CA, 3CB, para 3(5) respectively. 43B, class 26, we'll have to carefully pick up these items. Tax, cess duty, labor welfare contribution, bonus, interest on working capital loan and term loan, leave encashment, rent for use of railway properties. These are the cases which we will have to fill up. Accrual in the current year, paid within the same year, or paid after the end of the financial year, but before the due date of filing return, allowed. But due date is crossed, then only in the year of actual payment it will qualify. Now, accrued in the current year, paid in the very same year, before 31st March, not required to be reported. The purpose is outstanding on 31st March, but paid after the due date of furnishing return. That is only to be reported. The language gives a confusion that anything accrued, paid within the same financial year, also required to be reported. But our guidance note, earlier edition itself very clearly says outstanding on 31st March. not paid before the due date of furnishing return to be culled out, paid before the due date of furnishing return to be culled out. This is what the proceeding all about. Now, two things are there. Opening brought forward, disallowed, opening brought forward, paid in the current financial year, not paid. Current year accrued outstanding on 31st March, paid during the financial after up to the date of furnishing return thereafter. All that was fine. But today, the time to file tax audit report, time to file return of income, there is 1 month gap legally provided. On the date of issuing audit report, certain payments are not made, say bonus. But everything would be likely to be paid before the date of filing return. Let us say current year is a classic example, assuming due dates are not extended. 30th September, we are releasing the report. 31st October is the date for filing the return of income. 24th October is going to be Diwali. At least 1 or 2 days before that, bonus would be paid. As I would say, I am entitled for it. Now, 30th September, bonus not paid, we are reporting it. While filing the return after 24th October bonus payment, 28th October, 29th October, the assay uploads the return where he claims bonus under 43B. Now, 143, 1 small a, class 4. The CPC reads, audit report says bonus disallowable this much. But ITR says bonus disallowable only this much or 0. Audit report says more disallowance. Actual disallowance is either 0 or small. Therefore, we are proposing to add it. So when I was in direct tax committee, central direct tax committee year before last year, I said, why can't we make a representation to say in the return, outstanding on 31st March, paid before the audit report date, paid after audit report date, but before the due date of filing return. In the return itself, 1 column we can add. So up to audit report date, we'll give one information. Let the system compare this with CPC information with tax audit report. There is no variation, no addition. Over and above whatever comes, let it be allowed and subsequently it could be verified on a test check basis. That is how we can at least see that this particular error could be avoided. But it was represented, but instead the government came up with a new thinking process. In this case, subsequent to release of audit report, but before filing return, the assessee has paid more money. As a result of which the disallowance comes down, the audit report could be revised. Legally, provisions came into income tax rules permitting revision of audit report because of application of 43B, 40A1A, 40A1. 40A1, 40A1A, up to the due date of furnishing return, you can pay TDS. That results in reducing the disallowance component. So after audit report date, before the actual due date of filing return, if something is done subsequently and the assessee would like to take the benefit of it, in which case, instead of giving information in the return to reconcile, audit report is required to be revised to see that the assessee's benefit is preserved. So now, originally we'll give one report, withdraw that, DIN will be revoked. Subsequently, another report will be given later on to see that the numbers match, so that when the CPC processes the return, there will not be a demand. That's what the rule 6G got amended to say audit report can be revised for the sake of revising number 40A1, 40A1A, 43B. So that's a practical aspect. We have to see, otherwise every time the issue would crop up. Now, penalty, fine, capital expenses, we'll have to carefully go through the ledgers. Personal expense, capital or revenue classes are there. Personal expense, generally some senior auditors used to say some ad hoc disallowance they'll make, estimate of personal expense they'll make. And sometimes later days, that's all not taken. Earlier days it used to be. It is better a small portion of personal expense and other expense estimated as disallowance. Why do we say so? Later on, in a scrutiny proceeding, if there is some disallowance or some estimates are happening, let us say 20% of your car expense, I'll take it as personal, or your insurance, or your vehicle driver salary, something later on comes. And the C is unable to succeed in its attempt of proving that everything is for business. In which case he is agreeing to that and he is willing to pay and get rid of it. What could be the consequence? 270A may throw open some challenges. ASSI can say it is estimate, etc. It can have other alternative theories. But in 270A subsection 6 itself, if it says no penalty will be leviable in case where assessee has made voluntarily an estimate of disallowance that gets increased by the assessing officer, then for that increase of the estimate made by the assessing officer, no penalty is leviable. So when we voluntarily make a small disallowance on estimate basis and the officer makes a bigger estimate, we can say, I have made this much, you have made this much, I am not finding it worth litigating, therefore I'll pay. Penalty will not be leviable. At least to that extent, this will save the case. Therefore, personal element or some non-business purpose 38(2), etc., a small disallowance in every return would help the assessee to defend the case later on when 270A is thought to be invoked. 48(3) related cases, I would say this by itself is a very interesting subject, but very quickly to say, again, documentation, what I said for 269 SST, compare the bank statement, go through whether there is any cash entry found, and accordingly check up for some periodical payments, document and do it. Previously, payment made on a Sunday or a bank holiday was considered to be a permissible exception. On 29 January 2020, clause J dealing with this was omitted, and therefore after that even Sunday we can't claim it as an exceptional payment for cash. And 48(3), how to deal with them in direct deposit of supplier account. We go and deposit in his bank account. Purpose is achieved, therefore we can say we have satisfied. But sometimes it may throw open certain challenges one has to sail through by undergoing the ordeal. Genuineness versus compelling circumstances. Again, what I said for 269 SSNT. If we say I have paid money in cash exceeding 10,000, other person has reported his collection also. Both of us have accounted. Therefore, it should not lead to disallowance. When this argument was placed, very interestingly, courts have said 40A3 will apply only for a genuine transaction. If it is a non-genuine transaction or a bogus transaction, 36, 37, 30, 30, 30 to 36, 37 itself will not allow you. Only for an eligible transaction, we have to test 40A3. For an ineligible transaction, we don't require 40A3. Having made an eligible transaction, and when you are applying 40A3, you say it's eligible transaction, genuine transaction, therefore 40A3 should not apply. Courts have not agreed for this. We can take a view subsequently to argue that it should be, but these are all going to create a very great legal trouble for the assessee. Rather than arguing it is genuine, assessee should always come up with compelling circumstances. What made him to violate the law that day? If that is made up, that would help the assessee. Otherwise, that is going to cause nuisance value, very difficult for us to sail through. And from our side, as documentation, we have to make robust documentation. This is one area, if it is subsequently found, the assees are in trouble and equally the auditors are in trouble, and therefore we have to make our documentation robust. And in real estate cases, the cash transactions are going to be really very high. If a survey takes place, cash received, cash paid. If you factor both cash receipt and cash payment, margin will be real. You remove cash receipt and cash payment both, margin will be minimum. But if you remove cash payment alone, but account for cash receipts, the income earned will be far less than what income reported. Therefore, assessee will insist for accounting of both cash receipt and cash payment. If you maintain your book like that post survey, 40A3 will be a troublesome factor that will really throw open challenges. We have one practical case where in a course of survey, assessee said, I have accounted all these sales for 2 crore rupees, but I have made 10 crore rupees out of the deal. And I have accounted for 1.5 crore rupees purchases, but I have paid 8 crore rupees for that. So you account 8 crore purchases, 10 crore sales, and also all the other expenses for development. Whatever profit came, I will pay. Accepted, survey closed, returns filed, scrutiny started. At that time, assessing officer said, all I'll accept 1.5 crore purchase price as per document, 8 crore is your survey statement, balance 6.5 crore genuine, but under 40A3 I'll disallow. Now, profit reported plus 6.5 crore. Matter is now before Madras High Court. So therefore, that is a case where for a real estate transaction, obviously, it may throw open challenges under 40A3. We'll have to be careful when presenting the case. Interest and remuneration paid to your partner. Now, interest paid to a partner, interest paid to others as well as partner, all covered under 36(1)(3). Now, interest paid to a partner, carefully we have to see on a cash basis following assessing. Normally, interest is computed on a product base and debited to interest account, credited to partner's account. Now, if the assessee is following cash basis, say for example, finance business, money lending business, cash basis is followed. In those cases, you make a journal entry debiting interest account, crediting partner's account, and physically money is not paid. And that forms part of a substantial portion of the expenditure. Revenue tomorrow may come up and say, you are following cash basis. Interest is first an expenditure under 36(1)(3) and further controlled by 40B. 36(1)(3) is only enabling provision for you. You have to pay interest to claim this. You have not paid to partner. Therefore, we will not allow this. In the year in which you are paying, you claim it. Will not disturb that. So in those cases, when the assessee is in a finance business, doing in partnership mode, wanting to claim interest or for that matter remuneration, we will have to advise them to draw periodically interest or draw periodically money, so that whatever interest paid in intragonum, we can say he has drawn then and there. At least to that extent, the claim will be surviving. If he is not drawing at all, money continues to remain only as an added to his account, then where you have cash basis of accounting, allowability will be a question, even for interest and remuneration is something which one has to remember. Now, there are so many more other aspects, but considering the time available, I will now directly go to class 44, leaving all other things, and in question answer, we will discuss the remaining things. Class 44 and 30C, both are the one which made applicable, withdrawn, or rather kept in abeyance for some time, now comes in another form. And our yesterday released guidance note also gives some interesting outcome on that. Now, class 44, it says expenditure. First line is expenditure. And now total expenditure, out of that, what you have incurred from a registered person, unregistered person, entity. Now we will have to see first income and expenditure or a manufacturing, trading, profit and loss account side. Expenditure includes purchases. Athar Singh Gutmukh Singh Supreme Court judgment says expenditure for income tax purpose includes purchases. So therefore, we'll have to count purchases, other expenditure, everything for our discussion. Now, having taken this, now what is the difference between expenditure and allowance? Now, expenditure is something, there are three important differences we have to consider. A deduction towards allowance, a deduction towards expenditure, a deduction towards a loss. All the three available under income tax law. Expenditure is something which I pay voluntarily out of my pocket. Loss is something which is devolving on me unconditionally or unexpectedly. I'm not anticipating it. Allowance is neither loss nor expenditure. Government gives you as a benefit. So now there can be an allowance debited to profit and loss account, depreciation allowance. There can be a loss debited to profit and loss account. There can be an expenditure debited to profit and loss account. So now expenditure means neither allowance nor losses. Having removed the losses, having removed the allowances, we'll have to confine ourselves only to expenditure. Now expenditure debited to profit and loss account, 1. Law says expenditure incurred, rather this class says expenditure incurred. And therefore we should not only confine to the expenditure on the revenue account, we will have to confine ourselves to consider the expenditure on capital side. So expenditure in acquiring a machinery, expenditure in acquiring the other assets, all that also we have to factor it. Now, whether list wise or every head wise, we should fill that number and give all the 7 clauses, 7 columns, or we can aggregate. Now the purpose is only to aggregate because the first line says total. And therefore, not necessary each ledger or each head of account we don't need to independently furnish information, aggregate them. When we are aggregating, revenue account all one, capital side all one, we can take up, aggregate both, nothing wrong in it, but when they compare with profit and loss account, it may sometimes throw open certain challenges. Therefore, better all revenue items aggregated one line, all capital items aggregated one line. Revenue items, we link it with profit and loss account information. At least to that extent, there will be some clarity. Now, expenditure from an entity registered or unregistered, we are bifurcating. Within the registered, if information is able to be culled out, we divide further exempt, then taxable entities and compounding associates. The next line total, the language used is payment made. There is inconsistency. First column exempt, then compounding, then comes others. That means registered normal rates. Then the aggregate of which says total payment. That means for these people, if you do not pay on 31st March, whether we have to report or not to report, the confusion comes. So I've got it from exempt supplier, I've got something from compounding rate supplier, something I've got it from regular normal, for which aggregate of all, I don't pay something on 31st March. Should I have to exclude it? Because the language used there is payment for the total of it. So, but our institute guidance note released yesterday says, in order to make consistency, the total of these three should come in the fourth one. Therefore, even though the language used is payment, we have to presume that it is paid or unpaid, it is accrued. So, compounding, exempt, other normal, aggregate of which should come in column 6, even though the language used is payment. And one line for all revenue transaction, one line for all capital transaction. Now, as the language is entity, the language used in all the headings, entity. So, entity registered, entity not registered. There are certain expenses which are not from entity. Let us say, for example, employee salary. Employee salary is not from an entity coming up, a registerable entity coming up. So therefore, that will not figure out in any one of these classes. It is neither exempt nor compounding nor normal rate nor total of it nor exempt other than these unregistered people. So therefore, it will not come under that. Therefore, that can be excluded. Now, if a company has got sitting fees payable or paid to its director other than full-time director, it's reverse charge. So now it is a service which is otherwise chargeable, not like exempt salary where that's not even coming within the GST. That alone will get picked up. But otherwise, normal wages and salary will not come. Now, if there is a bad debt, it's a loss. If there is any discount, that is abatement of sales price, that is not an expenditure. So those things should not come. Now, there are cases where advance payments are made. They are yet to be qualifying for expenditure. Tomorrow we may cancel contract, get the money back. So the advance payment will not be required to be factored. Actual outflow, either on revenue account or on capital account, required to be mentioned. Then now at least unregistered, registered in gross parlance, we will be able to at least get it out. But within that, how do we further divide compounding associates or for that matter dealers who are unregistered or the items which are exempt like diesel, petrol, all that will come under exempt category. So in all those cases, available information need to be cross-verified with the GST information returns file. Sometimes reconciliation will throw some challenges, no doubt about it. If the documents are comfortably available and verification gives us the comfort by doing Excel reconciliation, etc., fine. In case the data is not adequately maintained, because people thought this year also it will get extended. The exemption provided for this clause will get extended, but they've not done it, and therefore now it becomes obligation on our part to report it. The ASCI's obligation is to report, our obligation is to verify the correctness of the same. In that scenario, if information is adequately available and we are able to cross-verify, fine. There are still some cases where what is in the books, what is in GST return, it will not match, because some part-time people used to file GST returns, and those GST returns are not sometimes matching with the books, and therefore information, verification of that information with that would be really posing some challenges. In that case, we can get an MRL from SSA and see that the information is giving certain basic information to verify the correctness of the same. If our comfort level is extremely less, it is ideal to give a disclaimer on those numbers. Instead of saying that number itself is not workable, ASSI can come up with some numbers. This is exam transaction, this is compounding, or this is registered persons, or it is unregistered person. Compounding, I don't have anything like that. He can come up with some number. But if adequate documents are not available for us to verify, we can make a disclaimer. But saying we will not furnish the number at all may put the SSC in trouble. Some information you should be able to have. Better to give some information, and thereafter that a verification level comfort is less, we can give a disclaimer in class para 3 of 3CA, para 5 of 3CB, but giving some information from assessee side, which at least start contributing for the column. Otherwise, if he says nil, sometimes giving nil, but having huge purchases, etc., expenses, and giving nil in class of 44 may throw open some challenges of ASSI getting scrutiny, etc. Other consequences will follow. Better to at least give some number rather than giving zero. And if the adequate documentation is not available, better to go for disclaimer. And I think with this available time, I will stop at this stage. There are 4 or 5 questions came up from the studies group of Nellore branch on certain matters. That I will now take it up and then leave it to the floor for discussion. There are few questions which came up and they have circulated to me. Let me quickly go through that. Madam has sent one message wherein some questions were posed. The query reads like, late fees paid under income tax act to be claimed as an expense or to be disallowed. See, income tax law,
Late fee is a fee.
What is typed here is late fee, sir, but we will discuss. No problem. Fee paid. Fee paid either will have so many fees, but it's 230, and thereafter 200 rupees per day fee. All that what we are paying. The conservative approach is to disallow it. And now extending this theory further, interest paid, what will happen? 234B, 234A, 234C, disallowed. But what will happen to 201(1)A? 201(1)A, interest paid, whether that is to be allowed or not, it is to be disallowed. Now, there are a number of instances where the courts have come to say this is not permissible. Now, there are, I think, Karnataka High Court judgment versus Madras High Court judgment, contradictory views have come. Not in the context of interest, because primarily the Supreme Court judgment on Lakshman Das Mathur Das case said if the payment is compensatory in nature, it is to be allowed. If the payment is penal in nature, it will not be allowed. It was given in the context of sales tax related interest. Sales tax was permissible deduction. Interest thereon for delay in holding the money therefore it is allowed. In income tax, the particular amount is otherwise not allowable as income tax. Income tax is not a permissible deduction. Therefore, belated payment of income tax along with interest is also not permissible. Fee is for violation. You are not doing certain things within the stipulated time, and therefore law wants you to pay along with fee. And therefore that fee is also not permissible as deduction. Slight variation can come where we don't deduct tax, but we pay on their behalf. We omit to deduct. We pay full money to them. In order to comply the law, we pay TDS also. That amount of TDS, when we are charging to profit and loss account, is it income tax, therefore not allowable, or it's a business money which I am paying to him voluntarily? He has asked me to pay 100, I am paying 110. Giving 10 rupees TDS certificate, also 100 rupees payment to him. That's additional payment I am making. It's a business payment. Can we claim it? That is where court come for the rescue of the asset to say you are paying more for service. It is not a tax, it is only the contractual payment more, therefore it is permissible. Other cases going to be a controversial subject, better to avoid. Penalty paid towards GST while transporting the goods at checkpost or any other place while goods are in transit, can the same be claimed as an expense or to be disallowed? Sir, now penalty, there are 3 classes in penalty. Penalty for infraction of law. Now, when the penalty is levied in GST regime, what is the infraction? The assessee is able to demonstrate there is nothing wrong in order to see that the vehicle moves faster. He has agreed. Otherwise, it will stop his business. Therefore, he has agreed. But robust document is available to say that thing went wrong, but he has not litigated. Fine. Otherwise, it's amounting to violation of law. So, penalty for violation of law straight away disallowable. Disallowance under 40A 2B, payment by state government undertaking to state government, whether completely to be disallowed or only for TDS related payments. Sir, this particular case, some payable by state government undertakings to state government by way of fee. It came up, the amendment came up when the fee was payable by certain PSUs to state governments. Tamil Nadu was one and Gujarat was one at that time. They were collecting money from the PSUs on the revenue generating PSUs. Their share, instead of collecting as dividend, they collected as fee. To see that that is not permissible, the amendment came to say fees payable by these PSUs to the state government is not a permissible deduction. You disallow and pay income tax. That's how the law came up. It is nothing to do with TDS because the payment is paid to a state government. When payment is made to a state government, question of TDS does not arise. This section is nowhere linked with this particular clause, is nowhere linked with the TDS. So to the extent tax not deducted, therefore it is disallowable. If tax is deducted, therefore it is allowable. That theory would not be applicable. This straight away PSUs, state paying money to state government by way of fee, that is not permissible because of state provision. But we have the Supreme Court judgment to say that to the extent it is covered there, the fee paid, it is inadmissible. There are a few other freight reimbursement, etc. Judgment goes to say it's actual contractual aspects that will be permissible. Disallowance under 40A5. How do we figure out the exact TDS amount paid for non-monetary perquisite given to employees? So, non-monetary perquisites, the assessee provides non-monetary perquisites for which there are 2 elements here. First, he provides non-monetary perquisites. Now, for which he has to deduct tax. In order not to disturb the employee, he voluntarily pays tax. Now, the tax on non-monetary perquisites borne by the assessee and voluntarily paid by assessee requires to be reported. Now, voluntarily assessee himself says, these are the perquisites I have given to employee. It's a non-monetary. I don't want to recover the tax from him. Voluntarily, I'll pay, I'll disallow. In that case, Challan itself will say, he has paid, not recovered from anybody, out of pocket it is paid. Therefore, we can say. Whether that is sufficient or not, whether that non-monetary purpose on which tax is paid, whether it is sufficient or not, assessee should have robust working. That has to be test checked. Whether each employee, how much he has got those non-monetary perquisite factored in his salary and tax is required to be ordered. He did not pay, voluntarily the employer can pay. Based on the facts of the case, we have to do test check and ascertain. If he has paid voluntarily, we'll have to pull out from Challan and report here. If he has not paid, then the question arises, tax not paid, but salary. To that extent, section 192 will trigger. If tax is not paid, but it is provided for, to that extent, 40A1A would come into picture. That exercise we have to consider. Then capital expenditure to be included for the purpose of class 44. I think we have already discussed capital expenditure is required to be considered. The last one is whether 44 ADA, whether profession definition inclusive or exclusive. 44 ADA 11 profession. 44 AA subsection to all other profession. But they are in that 11 is exclusive. Within that 11, let us say for example, profession of accountancy need not be chartered accountant, cost accountant, or having any degree on accountancy practicing will also come. But it is profession of accountancy. To appreciate this controversy better, for 44 AD, ADA, AE, this PC has come up for the returns, come up with a code. For each code, what business it represents. If you take that code, it will be easy for us to identify for each of the businesses, what are the matters we can, what are the type of businesses we can rope in. That would help us to appreciate things better. So that way we can link with this particular proposition. With that, I think the queries raised here, we had addressed. Now, what is there in chat box? I'll quickly see. In future, should we show all income to credit of P&L account so that we can prevent 143 one-year notices or not showing the same in tax audit report? So if the income is shown in the credit of P&L account and removed from the profit of the business reported in other heads, fine. If it is not shown in the P&L account but directly taken to the capital account, not to be shown in class 13, so long as TASI reports in the computation of total income, nothing wrong in it. It should not be reported in class 13 as if not credited to P&L account. That precaution we have to take. Payment to creditor, should it be disclosed under 44? Payment to creditor on the accrual basis, if it is already factored, subsequent payment is not required to be factored. If last year it is expenditure incurred, opening creditor paid current year. Last year there is no obligation to report. Therefore, opening creditor payment need not be mentioned. Current year accrual we are reporting. Current year payment or subsequent year payment we don't need to report. So accrual itself we report, it is sufficient. So separately payment need not be factored. With this, I think whatever in chat box and the questions received, I have answered. Any other question you would like to handle subject to organizers awarding the time, we can handle it.
Sir, in the chat box, to the last question before, there is another question, sir. Please go through it.
Oh, see, let me check. One of the client is running hospital and paying consultancy to doctors. Where shall I report the expenses under 44? The client is running hospital, paying consultancy amount to the doctor. Now, from the doctor's perspective, whether there is any need to consider this as a registerable event. If it is a doctor medical services, it is not registerable, similar to exempt service by itself. So obviously, it will not figure out. It is not required to be mentioned.
Oh, not required to mention anywhere in the.
In the class 44, it will not come. Okay. And a partner introduced cash into partnership firm as capital for more than 2 lakh during the year. Ideal to avoid, sir. Though we can say firm and partner one and the same for commercial law purpose, better to avoid. Firm and partner are two independent taxable entities under income tax law. One single entry more than 2 lakh rupees will invite trouble. If same day we make two independent entries less than 2 lakh but aggregate more than 2 lakh will invite trouble. But if it is going to be different dates, we can say it's a different occasion. Therefore, need not be clubbed. Person in computation, I think that question requires little more elaboration. And whether sale of teak plant is an agricultural income. Now, the plant itself is sold, it's a question now. Now, people cultivate teak for 5-7 years and thereafter one fine day they cut the teak and sell. Now, in that case, you cultivate, periodically grow and then sell. It's an agricultural income. Nothing wrong. We can easily get out of it. It's an agricultural income. Then rent paid to a partner. Sir. Yes, sir.
It's not a cultivated teak plant. It's like when they bought the agricultural land, there were teak plants. Okay. So they have sold it during the last year. So whether it forms part of agriculture income or business income.
Now there are two things. It will neither be agricultural income nor a business income. It will be coming under a capital receipt. See, when you are paying money for the purchase of land, for the T code also some factor should have been made. Though it is not appropriately specified, you can always bifurcate and do it. When you are purchasing land along with the saleable T code available therein, price would get factored for it. You are not into the business of purchasing land, cultivating or cultivated or ready T code land. You are not in the business of purchasing and selling such lands. Therefore, it is not a business income for you. You are once in a way cut that land, sell this, and thereafter use the land for some other purpose or for doing some other activity. In that case, it's a capital receipt. What's the cost involved? What's the sale price? Difference is the capital gain.
Okay, sir.
Fine. Now, what's the? In order to call it as an agricultural income, there must be primary and secondary activities carried out in the agricultural land by the assessee. So now he has got a land. Primary activities means the activity carried out upon seeds being put into the land and whatever comes from the surface. Up to that, whatever it does is a primary activity. After it is sprouted, whatever subsequently it does is the secondary activity. There must be both primary and secondary activity by the SSC to call it as an agricultural income. Primarily, this is first Soundarya nursery. We have to keep it in mind. There are certain exceptions, growing nursery, etc. Consciously, law got an exception to that. Explanation 3 came. Otherwise, this is to be seen. If the your land has already got some T code outright purchased, subsequently sold by cutting the tree, then it's a capital receipt. Fine. Rent paid to a partner, whether it is to be shown in class 23. Rent paid to a partner. Now, rent paid to a partner under 48 2B, if the question is on 48 2B, yes, it has to be shown. Reasonableness, it is for the AO to decide. For the auditor's perspective, it is a related party, it has to be shown. Person in composition scheme, 44 is applicable, whether the assessee in composition scheme or otherwise, class 44 is required to be reported. Whether capital expenditure which is to be reported includes purchase of immovable asset. Immovable asset to the extent if he is purchasing a land or is purchasing a building per se, that purchase of land or purchase of building per se would not figure out as an item which is from a registerable entity is getting, unless there is a factory building is purchasing from another company, which is a registerable entity. In that case, it may require to be, otherwise it is not required. GST exempt persons can fill class 44. Exempt person. I require a little more clarity on this question. Can I attach revised financials while filing revised Form 3CD? Interesting question. Form 3D revision. Now we'll have to examine for which purpose this Form 3CD revision takes place. If it is only for 43B, 40A, 1A, to that extent, there is no error in the original report filed. On that day, what was informed is correct. There is a subsequent development. Therefore, today when we are filing a revised report, what we are filing today is also correct. In that case, audit, the accounts will not undergo a change. What is getting disturbed is only the change in facts which warranted revision of audit report. In that case, revised audit report will, revised financials will attach financial, but that is no change in the financial. But facts are such that some error took place, calling for revision of accounts. Let us say this amount otherwise required to be credited to capital account got credited to profit and loss account or vice versa, calling for revision of accounts. Accounts are revised and revised audit report altogether given. Revised financials need to be given, but only problem is the first report is said to be not compliance with the law. Penalty consequences may come up. That is where ASSI should explain the reasonable cause for not able to pinpoint in the earlier occasion that he has to come up with. That's the only thing. Otherwise, in genuine scenarios, possible to file a revised.
Example of other than these error cases, sir. While filing the 3CD, I have disallowed the non-compliance of TDS provisions. Subsequently, he has ready to pay the GST and debiting to the party account.
Okay.
Then the receivable from party account also will increase in the balance sheet and payable also will come in the balance sheet. In that case, I have to revise the balance.
Naturally, balance sheet is getting altered. See, first he decided, let me get the invite, let me invite the problem of disallowance, I'll pay. Subsequently, he decides, okay, I'll recover from party.
Yes, sir.
Party is willing. So I'll alter the accounts. and he alters the accounts, debit, party account, credit, TDS, payable account. Before filing return, he pays the TDS also. And now it is a good case where 40A1A itself allows us to revise. Only thing is with alteration in balance sheet, receivable and payable, 40A1A is a leading provision for this. So automatically you can revise it along with revised P&L. And GST exempted businesses, tax audit, clause 44. The GST itself is exempt for a person. I will put this way, so in which scenario clause 44 may not be applicable, because the purpose of 44 is to collect the information on GST related matters. There it is not going, but GST exempt person. But what about his input? Suppose his input is liable for GST and he is not taking any ITC and his output is not liable for GST, their report is required merely because his output is exempt from GST. His input otherwise liable, the purchases need to be factored. That cannot be avoided. And example of capital expenditure to be reported. Let us say, for example, a person is purchasing a land. That's a capital expenditure. The other person selling is not a registered entity, an individual. This assessee is a registered GST registered assessee, is purchasing land. That amount of land purchase is an exempt transaction for GST. It is not required to be reported. Now, to take for his factory is purchasing a machinery. That other person who is selling machinery is a GST registered entity. This assessee is also a registered entity. The amount of purchase price on machinery incurred requires to be reported in clause 44. So where that is the difference between capital expenditure required to be reported and not required to be reported. That's how we will have to review the provision.
Some of the members has mentioned rental income in class 16, amounts not to be credited in P&L. So now they are getting notices from income tax department that demand notices, even though they have shown that rental income separately in ITR. So this issue is relating to financial year 19-20. So there is no scope for revision also. Now what to do?
Who said there is no scope for revision, my dear?
I mean,
you can file after 143(1) small a, before 143(1), there are 30 days time. At 30 days time, we file a revised 3CD, giving this as a reason, revoke your original EDIN, make a revised EDIN and make this class as a reason for doing it. We originally thought other income credited to capital account is required to be reported in class 13. But after receiving 143(1) small a intimation, it gives an impression that other income otherwise chargeable under the head business alone is required to be reported in class 13. Therefore, class 13 is requiring a revision. Accordingly, revised audit report is introduced. Give that note and give form 3CD fresh. Automatically, that would remove the 143(1) small a, demand would not come. GST payable to be disclosed in 43B when following exclusive method. Obviously, yes, sir. GST payable, whether you follow inclusive method or exclusive method. Saurangi Sales Bureau Supreme Court judgment says if your business collection is amounting business income, payment amounts to business expense, even if it is not routed through profit and loss account. It will be deemed as credited to P&L account, debited to P&L account. In that case, outstanding amount is as good as debited to P&L account, remaining outstanding. So to that extent, that remaining outstanding hit by 43B. To the extent it is paid before the due date of filing return, it will qualify. Thereafter, what is paid will be qualifying in the year of actual payment. Assessee maintaining same account for personal transaction and business. Bank closing balance includes personal and business. How to show closing balance of bank in business books while attaching form 3CD. Assessee maintaining same account for both. But in the business books, closing balance of bank balance will be closing balance, no doubt. But the transaction relating to business will be in business books. Transaction other than business will be charged as capital account. Closing bank balance can be the actual bank balance. That need not be further bifurcated out of how much business revenue bank balance comes, how much out of the personal transaction, because it is credit. And suppose, for example, he has received a dividend from company. That dividend is last 29th March came. It is sitting in the bank. Will credit his capital account, debit bank account. Bank balance can be the same. That need not be removed from bank account. It can continue to be in bank account balance in the return. Nothing wrong in it. A capital account is inflated to the extent of dividend contribution into the business books. That need not be removed from the bank account itself. Bank account need not be bifurcated between business separately, personal separately. That can be in one book. If he has got more than one bank account, 5 bank account, he has got 3 uses exclusively for business, 2 partly for business, partly for personal purpose. Now evaluate whether the remaining two also should be brought in. If they are brought in, bring everything, personal transaction, take it to capital. You are not brought in, put it outside, business and transaction through capital. But all said and done, please remember, all the bank account, whether closed, dormant, otherwise running, in the return of income, all bank accounts should be mentioned. Not for tax audit, for the benefit of the assessee. There are cases where 44 AD cases where 3 bank account he has given. Thereafter 2 bank account he has not given. Officer picked up the case 44 AD. In those 2 bank account also certain gross receipts were there. Assessee said for that also same percentage you give relief. I have offered 12%. For these gross receipts also I have got purchases I have not disclosed. Give me that same 12% benefit on those collections reported in those 2 bank accounts. Officer said those 2 bank accounts you have decided not to report to the government. That means they are not business bank account for you. It is other bank account. All the collection I will go under 16A. 110% effective rate. So all the bank account available with assessee report in the return. AAS number of bank account. Returns as per bank account, we'll have to see. Some of the cases where practical challenges could be, assessee would be a joint owner. He and his daughter would be studying. Therefore, you would have given that account. Daughter by that time may not have an identity proof. You would have given his PAN or other. That will be figuring out in the ECIS. Daughter would be using that bank account. Check. And if that is not shown in his return of account, we can explain it. Otherwise, all business bank accounts found in AAS at least should be found placed in the IT return of income under bank account column table. Otherwise, any credit found in the bank account not reported either inadvertently or otherwise may invite 69 series. And later on to define it as part of the business asset inadvertently omitted will take long time for us to get out of that problem, especially in faceless mode. Therefore, one has to be careful in presenting those matters while filing the return of income. I think all those queries we have handled it, sir.
Sir, in the case just now we were speaking, sir. As a tax auditor, I need to upload only the business balance sheet and profit and loss account only, right, sir?
Correct.
Attaching with 3CD.
Correct. No doubt.
While filing ITR, assessee have to report all the fixed rates, his personal fixed rates also in the class black.
If at all his income exceeds 50 lakh, his gross that total taxable income 50 lakh above, his personal balance sheets related information he has to punch.
Has to include along with
that
business
return,
balance sheet.
where his business and is not business, his total taxable income exceeds 50 lakh.
Yes, sir.
His personal balance sheet, land, building, shares, securities, jewelry, motor car, bank
also personal bank accounts
mentioned separately. That information comes from his personal balance sheet, which we are not auditing.
Yes, sir.
Only business balance sheet we are auditing and attaching.
Yes, sir. While filing his ITR, he has to club all together.
Not club. Business balance sheet information will come in the P&L balance sheet. Manufacturing account, trading account, balance, P&L account, balance sheet. What we are giving, the same will come. If the income is less than 50 lakh, his personal assets and liabilities will not come at all.
If the income exceeds 50 lakhs, in
income
that case,
exceeds 50 lakh, one business balance sheet, what we are giving will come in the manufacturing, trading, P&L account and balance sheet.
Yes, sir.
Personal balance sheet, there is a separate table. Personal assets and liabilities table. There, other than business balance sheet, all other assets will come. Their land, building, jewelry, motor car, what is not in business balance sheet should be separately mentioned. There is no consolidated balance sheet to be reported. What we have signed should come in manufacturing, trading, profit and loss account and balance sheet. Whatever we kept outside, that much alone will come in the table dealing with assets and liabilities for an assessee having 50 lakh above taxable income. There is no aggregation principle. You do aggregation, it will be misleading. In business balance sheet, you will also say this much asset. In personal column also, he will say the same amount again. That will lead to double counting. So that should not happen. The investment in partnership, investment in proprietorship will not be found in that particular table. Investment in proprietorship will anyway come in ITR, P&L balance sheet. Investment in partnership will anyway come in the statement relating to income from partnership, capital balance, salary, interest, bonus, less deduction. Therefore, that is not figured out again. That comes separately. All other assets personally found, land, building, motor car, vehicle, jewelry, those things alone will get figured out. Advances will figure out in the above 50 lakh category cases. That alone should come. An aggregated P&L balance sheet the SC may have. That should not be filled up in that column.
Okay.
Sir, in one case, associate is engaged in software training like C, C++, Java training. So does it comes under a specified profession?
Yes. Information technology, notified profession.
Teacher, sir, teacher, tuitions.
Tuition teacher is a profession, but not under 44 AA1. It will be 44 AA2. Other professional. 50% is not required to be offered so long it is less than 50. Above 50, anyway, audit is required. Teacher is a profession, automatically audit would be required. Less than 50, no problem. It will not come under 44 AA1.
So if we say teacher and we are showing only 20% net profit, so there is
teacher on what? Teacher on C plus etc. C plus. Teacher teaching in only for students.
Not C plus. It's like normal tuitions.
Tuition income you can always come under that. That will not come under information technology. But a person saying I'll take Java, but still I call myself as a teacher, very troublesome case.
Yes, sir. I think many of the queries have been solved, sir. Thank you for your patience for clarifying all our queries, sir. I request Vice Chairman of Nellore Branch, CA Harishankar, to present vote of thanks.
Yeah, good evening, everyone. It has been such an honor to be a part of this wonderful session. On behalf of the Management Committee of Nellore, Tirupati and West Godavari branches of SIRC of ICAI, I would like to extend my heartfelt gratitude to our esteemed speaker, CA Shri Ramnath Garu, and our official member of Nellore branch of SIRC of ICAI, Shri Mandava Sunil Garu. Finally, I would like to thank all of you present here for making the time to be with us today. Thank you all.
Thank you, sir.
Please take care of health while doing audit. This is a time where our members are always getting caught with so much of pressure. Therefore, take care of health. Family health are very important. SSC, important, no doubt about it, but that is not the prime most thing. Take care of health and do the audit. Audit will be there, people will be there, but we have to be there. Therefore, take care of health and proceed. Thank you for the opportunity. Thanks, one and all.
Thank you, sir. Thank you, sir. Lovely session.
Thank you everyone for joining and making this session successful.